Up consumer savings, your excess savings of $2 trillion, massive pent-up demand to spend that money. You've got incremental government stimulus, and you've got, very importantly, central banks that are not only going to keep their foot on the gas. I mean, they're just going to keep adding accommodation to this economy. So I think this is a very strong setup for the economy. That's a strong setup for revenue growth and earnings growth.
Ron, I was going to go to your really wonderful research note where you synthesize our economics into our market performance, as you've done for decades. But I've got a note here at the end of the quarter. S&P 500 over the last decade has not done the single-digit return people like you predicted. Everybody else was in a single-digit actuarial assumption. It's 15.55% per year for whatever sets of reasons. Is this the great miscall that we assume single-digit equity return and we were wrong?
Well, I think the starting point always matters, by the way. The last decade, you obviously started from a pretty low level. But I do think most people who try to make these forecasts always try to be on the conservative side. No one wants to be out there. Well, occasionally you get one forecaster who wants to be out there calling some outrageous call, but see, if you get it right, you get a lot of notoriety. But I think, there has been a miscall in terms of we've always been looking backward and saying, what should valuation be? And I guess you have to really always think about context, right? With these kind of interest rates, it doesn't make sense to think that equity markets should always trade at the same valuation they did when you had a 10-year Treasury yield at 5 or 6%. And so I do think you continue to have upside in these markets. It's going to be driven by earnings growth and perhaps even more multiple expansion. The more important thing, by the way, Tom, I think is really to watch for the rotation within the market. And I think that's going to be important over the next year as well.
Ron, I want to pick up on something you said. At these kinds of interest rates, the multiples may be somewhat different for stocks. These interest rates are changing. We just had the worst first quarter for U.S. Treasuries going back to 1980, and it looks like perhaps you are among those who think that perhaps we could see even a further increase in yields and further losses ahead. At what point does that start to change the multiple expectation, that what you're pricing in for stocks, and actually bring down your expectations and, frankly, prompt you to sell?
Well, I think when I pointed out that I think there's a rotation, I think this is a really important part in equities right now, is we tend to talk about the market. But I think what's more important is looking within the market and saying what will work and what might be hurt by those rising interest rates. So I do indeed think we can continue to see steepening in the yield curve. I think a 2 to 2.25% 10-year yield is very much likely in the next few months. And as those long-end interest rates go up, I think investors have to become a bit more critical of buying companies whose share prices are driven by cash flow far into the future. And so what you might think of there is those kind of turbocharged momentum growth stocks that really led the rally for the last couple of years. You have to really start thinking about what discount rate you apply to earnings in 5 to 10 years.
Ron,
now, there are other companies, though, earning money now you should pay more for.
Ron, this is really critical. I mentioned this the other day to someone taking CFA level 5 or 6. I can't remember which. Ron Temple, do we have to adjust our terminal rate in the timeline to our terminal rate because of all this fiscal mumbo jumbo we're all dealing with?
Well, I think over the next 1 to 2 years, you do need to be raising your discount rate on those long-dated cash flows and really thinking about what am I paying for and when will I get that cash? I think there are some substantial parts of the market, by the way, that are still inexpensive, where you're getting the cash now and where you're frankly either getting a cyclical upturn in those earnings or you've got really high quality companies that can compound their quality over time and grow those earnings from a high base. So I think it's going to get, again, a more nuanced rotation within the markets. It's not a simple sell growth buy value story. I would argue it's a quality growth positive story, a cyclical recovery positive story, and a negative story for kind of business plans. There are less business and more plan.
Ron, it's good to catch up, sir. It's good to see you. Good morning to you. Ron Temple there of Lazard Asset Management, leaving behind just a monster first quarter. Lisa mentioning the performance of treasuries, or rather the lack of performance of treasuries, up at almost 83 basis points over the previous 3 months. And the first quarter was about expecting what would happen through the rest of the year. The outlook, it brightens. Q2 is the show me the money quarter. Q2, Q3, this is about the data. And Tom Keene, that data, it starts this Friday.
Well, it starts this Friday with a jobs report, but it's also starting with the beginning percolation of earnings. I thought McCormick this week, the spice company, was very important with a bang-up quarter. But, John, there's a lot of different points here to get to Q2, yes.
Yeah.
Maybe the mystery of Q3, but I don't think we have a clue of the framework of Q4 and Q1 into next year.
2022, Lisa. on deck very, very quickly as well, and the word deceleration, which we've been investigating over the last couple of weeks, I think it comes up more and more. Tom, I'm just going to disregard all of that. And Lisa, we've heard several people start to say the boom times that they've anticipated for 21, they're also starting to think about 22 maybe in the first quarter too.
Could we get burning hotter and then shorter? And how much can people look through the inflationary impulse that we're expecting?
I'm just navigating the next couple of hours without getting into an argument with you, Tom. I'm almost there.
Here.
I'm almost there.
I look around.
Yes, he is.
It's not
really?
Old and empty.
It's not going to work.
Really?
No one's around to judge
That's a dare.
me.
Nice.
I can't see clearly,
Do you
John,
need to beatbox over the top of this?
gone.
Coming up next, Jared Bernstein, White House Counsel of Economic Advisors member. He'll be joining us in the next hour. Don't miss that conversation. Oh, yeah, sure. Okay. Approaching 4K on the S&P 500. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Republicans in Congress are opposed to the way President Biden wants to pay for his $2.2 trillion infrastructure plan. The president wants to raise the corporate tax and set a 21% minimum tax on global corporate earnings. Senate Republican leader Mitch McConnell calls the president's plan a Trojan horse that brings with it more borrowed money and massive tax hikes. It's an alarming sign that Europe is once more losing control of the pandemic. France's President Emmanuel Macron announced a nationwide 4-week lockdown, closing schools and businesses. That represents a reversal for Macron, who he had favored a localized approach, which the UK also tried with little success. OPEC's official warning that oil demand remains fragile. Secretary General Mohammed Barkindo told energy ministers, quote, "We should not be out smelling the flowers just yet." OPEC and its allies meet today for talks on whether to prolong their vast production cutbacks. It's another blow to Hong Kong's beleaguered opposition. The city's so-called father of democracy, Martin Lee, and media mogul Jimmy Lai were convicted of attending an unauthorized protest in 2019. 5 others also were convicted. They'll be sentenced next month. The verdict came shortly after China approved a plan that effectively ends open elections in Hong Kong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Today, I'm proposing a plan for the nation that rewards work, not just rewards wealth. It builds a fair economy that gives everybody a chance to succeed. And it's going to create the strongest, most resilient, innovative economy in the world. It's not a plan that tinkers around the edges. It's a once-in-a-generation investment in America.
The President of the United States unveiling a $2.25 trillion spending plan from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here is the Thursday morning price action shaping up as follows. On the S&P 500, we'll whip through the quarterly numbers a little bit later in the hour. Right now on the session, up 13 on the S&P, up 1/3 of 1%. Nice pop on the NASDAQ, up another 9/10 of 1%. In the bond market, Tom, bonds with a bid. Treasury yields lower by 2 basis points to 172. Higher through the previous 3 months by 83 basis points. Quite a rout in treasuries. Outside of that, into the commodity market, much more on this later as well. Up 2.35% on crude to $60.55. And before we start drowning in gloom, can I just bring up the latest data around vaccinations? Actually, not you, Lisa. Not this time. 2.83 million doses per day over the last 7 days. That, Tom Keene, is your daily average of vaccinations in America.
And the announcement, among other political moments, of Delta Airlines yesterday that they will fill the middle seat at some point, maybe part of that pandemic celebration. Certainly better news, although there's some variant issues out there. Futures up 13, as John mentions, NASDAQ leading the way 2 days in a row. Right now on infrastructure, Jan Fitzpatrick joins us. You will find the time to parse 2.25 trillion this way and that. Jack, let me parse it simply to the bridge that the president has to get to the Democratic Party middle. He's got to bring in the middle of the Democratic Party. Did he succeed at that yesterday?
The middle of the party, yes. What he really is going to need to do next, though, is win over either all the progressives or make this bipartisan and get Republican support. The complaints on either end of the spectrum are about the size and scope, and on the Republican side, the pay for is with
Yeah, but come on. Jack, cut to the chase here. After the 14 articles John Farrell read, I read 13 articles. Lisa, knows more than we do. Cut to the chase. Who has the power here as we go to a debate of this bill?
Probably more the progressives. There's an expectation, widespread expectation among lawmakers I talked to that Republicans just aren't going to get on board. They were criticizing this before it even came out. The basic numbers are getting so much Republican pushback that the next question probably is, what can you do through this process of reconciliation that lets you do something partisan? They're going to try to get Republicans, and if it looks good there, sure, you can drop progressive votes to your question, he has won over the mainstream Democrats, the bulk of Democrats, but the margins are so narrow that these two ends are very much pitted against each other. And based on the Republican reactions, it looks more likely that he's going to be able to work with progressives than a good number of Republicans.
Jack, can you talk a little bit about how likely it is that this $2.25 trillion plan will get broken up into many pieces that some could actually get through sooner than later? I'm thinking of, for example, $100 billion of spending to support the semiconductor research and industry in the United States. What are we expecting and when?
Yeah, the packaging and sequencing is one of the hard parts. What you mentioned about semiconductors, basically the bipartisan or largely bipartisan portion of this relating to China could get broken off. There's going to be a separate announcement of a roughly $1 trillion more on the more human capital, childcare stuff. Progressives, and I've said they have a lot of influence here, want one big package and to push this through in one omnibus. But the questions around what you can and can't do through reconciliation to do this in a partisan way add a lot of uncertainty, and so this is very much up in the air. There's talk of one big package, but it could be two, it could be three. It's possible that $100 billion or so relevant to the China stuff gets broken off on its own. It wouldn't be surprising to see two or more.
Hey, Jack, I know many people asking yesterday, where's the rest of it? Where are the other tax hikes? What happened there? What are your thoughts on that? What's the approach here?
Yeah, they went with a pretty basic push for what Biden campaigned on. You had the corporate tax rate. You had not all of what Biden campaigned on, but they're basically breaking this up into the corporate side goes in this announcement, and then they're going to follow up with more on the income tax hikes for the next announcement. Again, it's not clear how ultimately Congress will package these to get together, but there is more to come on the inside, the income portion of this in the next announcement in the next couple weeks, probably.
Jack, how are they framing the next announcement, the next package? Is it a big redistribution effort, a wealth redistribution effort? How are they framing it right now?
Well, you could argue that some of this is that they already announced is a redistribution effort based on some of the climate change stuff. A number of things in here are set aside for communities that have been struggling economically. They've previewed this next one as sort of the broader human capital package. Honestly, they haven't really gotten to that one. They've been playing up this one so much as a massive economic boost that we'll have to see exactly what the message is for the second one. But it's going to be sort of paired as the next part of this one largely broad economic boost for both of these packages.
Hey, Jack, good to catch you up. Jack Fitzpatrick there of Bloomberg Government. Lisa, you just get the feeling there are so many decisions that just haven't been made yet.
This feels very much like an outline, like a starting point of negotiations, and we're probably not going to get anything concrete, potentially even until after the August recess in Washington, D.C., raising the questions of what could potentially get broken off sooner than that. I mean, they have until the midterm elections to really get something done with the Democratic majority, and it seems like that's the race right now, John, if they want to get something done, not on a bipartisan measure.
TK, you've seen this effort a million times before down in Washington, D.C. From your perspective, what's different about this?
What's different about this is the romance of another time and place where we actually passed legislation. There's a considered memory, John, in America about what used to be the political process. That was a celebration yesterday, and it runs up against the hard reality. And this is the number one thing, John. The clock is ticking to, I believe it's November 8, 2022.
You know, John, you asked this really good question. What's different this time? And I think it's a decade, 2 decades of inflation that have lagged behind expectations despite stimulus, despite printing money, despite the Fed inflating its balance sheet. And suddenly the idea of the Phillips curve is being thrown out. The idea of inflation is being thrown out. And everywhere around the world, governments are printing more money and saying we can incur deeper deficits and it won't necessarily matter. And that, to me, is a key difference that's marking this economic cycle.
A group of policymakers conditioned by the previous cycle. Coming up on this debate, Michael Potts Bond, Barclays head of global inflation-linked research. An important conversation just around the corner. From New York City this morning, good morning to you all. Equity futures doing nicely on the NASDAQ, up 0.9%. On the S&P 500, up 13 points. We advance 1/3%. And in the bond market, after a rout in treasuries, yields up through Q1 by almost 83 basis points on a US 10-year. Right now, 170, 179, yields in 2 basis points. From New York, this is Bloomberg Surveillance.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide, this is Bloomberg Surveillance Live on Bloomberg TV alongside Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. We leave behind Q1. Q1 was about expecting a better year ahead. Q2 is about actually seeing the data. And ahead of that, going into Q2, Q1 on the S&P 500, up around about a couple of percentage points. On the NASDAQ, up about 1.6. The Russell is where you saw your outperformance, up more than 12% through Q1. And right now, equity futures doing nicely. On a Russell, up 0.4%. On the NASDAQ, up 0.9%. In line with a better outlook. Higher Treasury yield. Switch up the board and get to the bond market. 2s, 10s, 30s. On your 10-year through Q1, yields up almost 83 basis points, but some stabilization in the last couple of days. We breached 177, and then we course corrected, and this is where we stayed. 172 right now, down a couple of basis points on a day. On 10s, on 30s, we come in around about 3 basis points. Now, this is what's important for me for the months ahead. It is not just about the data, it is about expectations relative to the data. So let's finish on this. The surprise index of Bloomberg for the US, and the lessons we learned coming out of the last big reopening effort at the end of last spring into summer. And the bar quite simply was set too low. This economy absolutely surged through expectations with huge positive surprises, and you can see that out through June, deeper into summer and into fall, or as we say, autumn. I'll leave that there. As we reopen, let's not have that debate right now.
Good luck.
Let me just get to the final point here. The bar this time is so much higher than where the bar was last time because we have been conditioned by the last reopening effort. So what's going to be interesting, Tom, for me, is to see how this economy performs relative to expectations for the months ahead and to compare and contrast this with what you expect out of Europe and elsewhere.
Yeah, I mean, the analog here is 1947, 48, and I can't even get there. I mean, it's just absolutely extraordinary what we see in a boom economy. Let us digress right now, and I don't even know how to state this. I mean, it's as if Tottenham won the Premier League 8 years in a row. Michael Pond owns a high ground in inflation analysis. He is at Barclays, and his team on inflation on the street is absolutely iconic in getting the inflation call right. He writes hyper-detailed research reports that, I'll be blunt, I don't understand most of it. It's way, way too complicated, and we're thrilled that Michael Pond is here today to give us a little light on our inflation fears. Michael Pond, interview after interview, it's out there. There's a gloom about rising inflation. Are you gloomy about rising inflation?
I'm an inflation strategist. Well, how would I be gloomy about the potential for a rise in inflation? Yeah, if you're a consumer and exposed to a loss of purchasing power, that's a problem. But as an inflation strategist, we actually want some inflation.
You want some inflation. Do you have an analog right now back to the 60s or 70s? Or do you say in a boom economy when you talk to Michael Gapin that this time is different and your study of inflation will be different into 2024?
Well, Tom, last summer, we, with our group, with our economists, wrote a piece with a title of Don't Believe the Hype. And we still believe in that. And it's proven truth so far. Core CPI right now is at 1.3%. So all those who are saying that we were going to get inflation like you've never seen so far has been proven wrong. But the reflation trade is not really about inflation today. It's about what's going to happen to inflation when demand comes back, maybe by the summer or Q3, and supply chains just can't keep up with that demand. And that's when you could have some inflation. So we really won't know how this inflation story plays out probably until the third quarter.
Yeah, Tom, that's what I think is important about this debate. Next couple of months, we'll see the data. I'm trying to understand what is crunch time, when you can no longer sit here and say it's transitory, that it's something else, but you can't spend the rest of the year just saying it's transitory, into 2022 saying it's still transitory. At some point, there's crunch time for this debate. It's clearly not the next couple of months, Tom, because of the base effects. Is it Q3? Is it later?
Yeah, okay. So is it Q3 or is it later? We don't know. Michael, give us an idea of your inflation strategy now. For our global Wall Street audience, what's the Barclays core strategy?
So despite our view that inflation is not about to surge, although we do expect core CPI to rise to 2.3% by the end of next year, so a modest rise, but not surge, we think that investors will be positioning for higher inflation. So from the beginning of the year, we've been pretty bullish on the inflation market, even though we haven't been bullish on inflation itself. So we think investors are going to be, for the next several quarters at least, more worried about higher inflation than they've been in a decade.
And let's talk about whether they're justified. I mean, some people are saying the reason why we got subpar or sub-expectation inflation over the past 20 years is because of China, the rise of China, and suppressing costs to a lot of the labor. This is what rendered the Phillips curve obsolete. Now we have a much wealthier China, and we have an impulse of trying to bring supply chains home. Does this change the equation and make it more likely that we'll get faster inflation than perhaps people are expecting, given the change in the global landscape?
Lisa, there are many structural factors that most can point to when thinking about why inflation has been low. China and globalization from the mid-'80s is certainly one of them. More confidence in the Fed's ability to push inflation lower is another. And that, too, could reverse in the sense that they're actually actively shooting for higher inflation than their target, 2% target, for a bit. So what we could see is inflation exceed their target for a bit, and then that gets embedded in inflation expectations. But there are other structural factors that have been keeping inflation low. For example, e-commerce. So the more transparent prices are, the more difficult it is for businesses to raise prices. And so the shift to online shopping, which has only been accelerated during the pandemic, is also another structural factor that is likely to keep inflation from rising on a structural basis. We could see some transitory inflation, even beyond the base effects. But right now, the Fed has said that it's sitting on its hands, not just through the base effects that we'll get over the next several months, but also the potential for inflation on a temporary basis is the way they see it in the fall. So, Jonathan, we could see the Fed anyway saying that they're going to see it as transitory all the way through the end of this year. The market may not be so patient.
John, I gotta say, is it just me, or does it feel like the range of potential inputs here to inflation just seems to be getting wider and wider? And yes, people are coming on with their calls on inflation, which is key to their entire investment thesis. Yeah. But the conviction just isn't there. Talk about humility, a lot of humility when it comes to understanding inflation.
Well, let's think about what we're discussing right now. We're not talking about inflation per se. We're talking about the PCE. And Michael, that's what's interesting about this. Outside of, say, the big weightings towards healthcare and rents, look at lumber prices, look at copper, look at crude, look at food prices. For a lot of people, Michael, watching this right now, maybe sitting there in the real world, away from what we discuss day to day, they don't talk about PCE, they talk about real life experience. And as far as they're concerned, Michael, prices have been going up for a long, long time. What do you make of that? The distinction between just your average consumer who believes house prices have been going up only in one direction, food prices have been going up only in one direction, and then this conversation that we have about lowflation and low prices for a long, long time.
Yeah, we hear that a lot from investors, and I throw asset prices, stocks, house prices as well. So you mentioned that PCE and CPI measure shelter costs through rents, but most individuals look at housing prices through house prices. And those have actually been rising quite rapidly over the past year. So that can get embedded in consumer inflation expectations and market inflation expectations as well. But when it comes to the inflation market, it is based on the CPI and PCE. So that could certainly filter through into expectations, which lead to higher inflation. But we get that question a lot over the decade plus. So it hasn't mattered. Perhaps it will this time around, though.
Michael, I do wonder, though, on the expectations front, I've got to say we haven't spent nearly enough time talking about it. For consumer expectations, for business expectations, which ultimately matter, because if they start to see high prices, they will pass that on to the consumer if they believe high prices are here to stay. How are you monitoring that right now?
Well, what we're seeing so far is that price indicators on the business side are rising pretty sharply. Whether we look at China PPI or import prices on goods from China or the U.S. PPI, yesterday we saw a nice high number from the prices paid component of the ISM survey, and that's certainly consistent with other surveys. So we're seeing is businesses are experiencing this rise in inflation, but they're still having trouble passing it on to consumers. Now, later this year, when demand really comes back, perhaps that's when they can pass it on to consumers, and we see a rise in consumer price inflation as well.
Michael, don't be a stranger. It's going to be a busy year for you, that's for sure. Michael Pond there, Barclays head of global inflation-linked research. And Tom, that's where things get a little bit more interesting, isn't it? The tolerance of consumers to higher prices. I remember Ellen Zettner and Morgan Stanley coming on with you and I a number of years ago on Bloomberg Radio talking about this, and we talk about the lack of higher tolerance to higher prices. I wonder what that looks like a little bit later this year.
In Mr. Pond's research, and folks, I really want to emphasize his work is hyper acute within the fixed income space. It's this word, as Ron Temple said earlier, of anchored expectations, and Pond is doing trades against that anchored expectations. John, I'd say it's a mystery. We really don't know the anchoring of expectations at the Fed level or in the market level as we go through a boom economy.
And Lisa, at the consumer level and at the business level too.
Yeah, and definitely we've already seen that inflation. I think it's good that you bring in the point of real world inflation versus some of these measures that the Fed looks at. Look, there's also a question of good inflation versus bad inflation. If food prices start going up, if lumber prices start going up, you get a slowdown in activity. We've seen this already in home sales. We've seen this when it comes to manufacturing slowing down because the input just isn't there. At what point does that stymie some of the momentum that the Fed is counting on to get this economy off its feet?
Look out for ISM manufacturing a little bit later this morning, 10 Eastern time. Prices paid have been absolutely surging. 83.5 is your median estimate on the prices paid component. A little bit on that a little bit later. From New York City this morning, good morning. Alongside Tom Keene and Lisa Brabitz, I'm Jonathan Ferro. A ton to get through this morning. A big spending plan down in Washington, D.C. And we need to touch on Credit Suisse. Is it fast becoming the problem child of European banking? Have you noticed how little we have talked about Deutsche Bank over the last couple of weeks? We'll do that in just a moment, a little bit later on this program. Here's the market for you. Futures up 11 points on the S&P 500. We advance 1/3%. In the bond market, can we call it a rout in Q1 for Treasuries? Probably. Yields in a couple of basis points to kick off Q2 at 171.61. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden says he's open to good faith negotiations with lawmakers on his $2.2 trillion infrastructure plan. Republicans already are making it clear they don't like the way the president wants to pay for the spending. He's proposed raising the corporate tax rate to 28%, plus there'd be a 21% minimum tax on global corporate earnings. Republicans in Congress say they'll work with Democrats on countering China's economic clout and dealing with a shortage of semiconductors. But the price tag of a Democratic proposal may drive away Republican support. Senate Democratic leader Chuck Schumer plans to wrap several China-related bills into one package. That includes $50 billion for semiconductor R&D. Bloomberg's learned that a manufacturing error affected 15 million doses worth of an ingredient for Johnson & Johnson's coronavirus vaccine. J&J is downplaying the situation. The company says it's met its most recent vaccine delivery target, and it says none of the doses made in the U.S. so far have come from the plant where the error happened. Egypt says it may seek around $1 billion in compensation for the Suez Canal crisis. The Suez Canal Authority called that a rough estimate of losses linked to transit fees and the costs of dredging and salvage operation. Taiwan's Evergreen Marine was the charterer of the ship that got stuck in the canal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Friday, a Bloomberg Television exclusive, a conversation with Baidu co-founder and CEO Robin Li.
We're far from done. We will continue to invest for the next 10, 20 years.
Watch the full interview only on Bloomberg Television.
Critical moment in our fight against the pandemic. As we see increases in cases, we can't afford to let our guard down. We are so close, so very close to getting back to the everyday activities we all miss so much.
A gloomy CDC this week, that's for sure. That was Dr. Rochelle Walensky. The gloom of the CDC contrasted against the hope fueled by the vaccine rollout in America. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abravitz, I'm Jonathan Ferro. Here's the Thursday morning price action. I'll whip through things quickly as we kick off Q2 for you. Kicking off the second quarter with equities higher, up 9/10 on the NASDAQ 100, up a third of 1% on the S&P 500. Yields are coming in, a couple of basis points on 10s. Highs of the first quarter, 177, just north of that. Right now 172. Keep an eye on the equity market. Had a sneak peek of 4K on the S&P 500 yesterday. Did not stick, did not breach it. We might have a little look at that a little bit later. I want to bring you some breaking headlines coming from Pfizer. They release a long-term follow-up and data from the phase 3 trial, and some of the data reads as follows, Tom. The Pfizer-BioNTech effort confirming that there is high efficacy and no serious safety concerns, and the shot is more than 91% effective after 6 months. So let me read that line again. The Pfizer shot more than 91% effective after 6 months.
And you get lucky, folks. We have a great booking team here that, of course, magically matches our bookings to breaking headlines and good news from Pfizer here on what we do. And we have the perfect guest right now to talk about this, and all of us dealing with what should we do, what should our behavior be in the coming months. Amber D'Souza is expert on what we call risk behavior out of Swarthmore and, of course, the Johns Hopkins Bloomberg School of Public Health. Dr. D'Souza is knee-deep in what we do with our behavior given medical crisis. Dr. D'Souza, thank you so much for joining us this morning. We are changing our behavior now, and pros like you are worried about rising cases, rising hospitalizations, indeed a fourth wave. Do we risk a fourth wave with our behavior based on pandemic optimism?
Yes, good morning. Absolutely. We have seen rates increase for the past week or two across all states. And we are in a moment where there's a lot of reason for optimism. We have more than a quarter of all Americans have their first dose of the vaccine. the end is in sight. Things will be getting better, but we are not there right now. And we see rates rising because people are being less cautious.
And this is normal behavior. I mean, I know at Swarthmore, Amber, you had to read Camus' The Plague at gunpoint. I mean, that's what you do at Swarthmore. And there's that optimism at the end of the book, but the pandemic keeps going. For our listeners and viewers across this nation and worldwide, what is the best practice right now to manage our optimism?
Well, a year into this pandemic, we do know what behaviors transmit the infection, and we do know how to be safe. So people want to see their friends and loved ones. We understand that we can be social while still physically distancing. So we need to maintain mask wearing when you're getting together with unvaccinated people, not get together in large groups. And we're seeing people not make those choices.
There's a question of what happens when we are perhaps 6 months post-pandemic, how often we have to get booster shots, how often we have to revisit COVID, whether COVID will become a sort of omnipresent virus that we have to grapple with and that continues to mutate. This Pfizer study that John was talking about, crucial in indicating that perhaps the vaccination has a longer lasting shelf life. What's your sense, based on the budding research, of how present coronavirus will be, and also with respect to the vaccines, how long-lasting their effects will be?
Yeah, this is a race right now of the virus versus the vaccine, and it depends on several factors. We do have really good news. We have high efficacy of the vaccine. It looks like the vaccine is also going to be effective in younger individuals from initial studies, as was mentioned. But we do have viruses mutate, and so with the initial information that we have on immunogenicity suggests that that it will last for months and probably years, the vaccine efficacy or natural immunity from infection. But as the virus mutates, it's very likely we will need some kind of booster shot at some future point. It won't be lifelong protection.
When it comes to herd immunity, do you have a sense of what that means now that we're getting an acceleration of vaccinations?
Yeah, so herd immunity is not an exact point, but we do need to have a critical mass of people vaccinated before we get that benefit of reduced transmission. And so we're going to need to see the majority of infections, majority of Americans vaccinated. So more than 50%, likely 60 or 70% before we really begin to see that benefit. But it is a matter where the more individuals that are vaccinated, the higher the benefit is. So we'll want to keep going and get those rates as high as we can.
Dr. D'Souza, when you see Delta Airlines say things are better and we're going to fill the middle seat in economy on an airplane, how does a pro like you respond?
I mean, these are really difficult choices. And so if there's vaccinated individuals who are wearing masks and, you know, getting together in a middle seat, the risk is going to be lower. But if it's unvaccinated individuals, if people are making choices before they get on those planes that have put them at increased risk, it really is a concern. And so I see us opening up at the same time. We need to be driven by the data. And we were bringing rates down. Things were looking good a few weeks ago, but they have taken a real turn for the worse. And I think that's why the alarm is being raised. We need to follow the data, and it suggests the increases that we see portend really badly for the next few weeks. And we need to turn this around if we don't want to see a huge fourth wave.
Doctor, thanks for being with us. Come back soon, won't you? Dr. Amber D'Souza there of Johns Hopkins Bloomberg School of Public Health. Tom, you mentioned the airlines. United, I believe, in the last 24 hours, indicating that domestic leisure demand, and I say leisure demand and not business demand, but domestic leisure demand in America almost totally recovered, has almost totally recovered already, just after Q1.
Well, it's out there. And, you know, I witnessed it. I know, John, as you go away, I think you're going to Capri or wherever you're going. I don't know where you're going.
I don't know if I'm coming back.
You know, I don't know if you're coming back. But the basic idea, John, here is, yeah, we're all racing to this, as Dr. D'Souza mentions. And again, I'm going to go to the micro headlines that we're seeing. I'm much more interested in the tick-by-tick earnings, revenues, COVID, airline headlines than I am about the big macro picture.
Can I go through these headlines just from Pfizer just one more time and add in something extra? So the additional study, the data that they're looking at indicates that the shot remains effective, 91% effective after 6 months. This doesn't mean that it is not effective after 6 months. It just means that we're at the 6 month stage of this study, and after 6 months it's still effective. The additional line that I want to add in, though, Lisa, is the following, that the data suggests the shot retains efficacy against the South Africa variant. So some strong positive news there as well.
Yeah, and this, I think, is feeding into the optimism that we can beat the pandemic, even if COVID remains omnipresent in some way. I think the focus is also going to be on that booster shot. Are we going to have the same effects from it? Are people going to feel ill after it? We're going to start sort of tweaking around the edges what we're going to be living with as this becomes part of the regimen for everybody when they're kids.
We're all waiting to get some kind of guidance from the CDC on what you can do if you've been vaccinated, and yet this week the CDC has just remained really gloomy. So if you're waiting for that guidance, I imagine you're going to have to wait maybe a little bit longer. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Up next in the next hour, Jared Bernstein, the White House Council of Economic Advisors member. Looking forward to that as we kick off Q2 with equities higher by 10 points on the S&P, up 0.25%. On the NASDAQ, up by 0.9%. This is Bloomberg Surveillance.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're kind of at the doorstep of finally getting a better look of what this recovery looks like.
There's been nothing like this in terms of the pandemic the rebound, now the stimulus, it's totally unique.
It's very mechanically driven, completely unnatural as far as recessions go. So now the recovery is somewhat unnatural as well.
We are going to see rates move higher. I think we see 2% in the 10-year within the next month or so as all this spending becomes reality.
There's certainly capacity to be surprised to the upside.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Goodbye Q1, hello Q2 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow, leaving behind a monster first quarter for the banks, Tom. The banks in America on the S&P 500 up almost 23 percentage points.
Didn't mention the banks in the last hour. They got a wake-up call here at the end of Q1. We'll talk about that in a minute. But yes, John, reversion to the mean, or is it actually the mean reality of a boom economy and they will continue to prosper? There's a great opinion on that right now in the street.
We'll see that boom in the numbers, Tom, tomorrow morning, 8:30 Eastern time. The expectations, where are we now with the median estimate?
650.
I've seen numbers of a million after a million after a million at the top end. That grouping around a million, shining bright.
Well, yeah, there's a two-part thing here, but as Michael Ferroli mentioned yesterday from J.P. Morgan, the fact is out X number of months, it's still 7 million bodies returning to the workforce. Are we talking, John, about job growth or actually just pandemic healing?
I think we're thinking both, Tom, and that's the issue right now going forward. Lisa, Q2, Q3, show me the money.
Yeah, that's going to be the key question, and I'm really excited actually for our conversation coming up because one of the key question marks has been what are people going to do in the United States with that more than $2 trillion of excess savings? How are they going to spend it as they can go out? Yes, leisure travel is rebounding with a vengeance. People are calling this revenge travel. People just want to go away, and John, I know that you are joining them.
What did Chris Harvey call this of Wells Fargo? Adult spring break for the rest of the year. Is that what he called it? Adult spring break
we all
for
need
2021. April 1st, look out for April Fools. That's what Tom says. I'm going to Capri and never coming back. Let's get to the markets. Equity futures up by 11. That might be an April Fool's. Who knows? Up 0.25% on the S&P 500. Into the bond market we go. Yields come in a couple of basis points. 172 on 10s. Yields come in after breaching 177 earlier this week. And we had a monster move higher in Treasury yield through the first quarter. 83 basis points almost. Outside of that, into foreign exchange, stable, Lisa. 117.34. And in commodities, a 59 handle on WTI. 59.90 and up about 1.3%.
Yeah, and that's ahead of an OPEC meeting where they're going to get together and decide whether or not to keep the caps on oil production, as we do expect things to remain muted, especially with what's going on in Europe. Today, jobs very much front and center. We're going to get 8:30 a.m. U.S. initial jobless claims. Very interesting to see how it is coming down to the lowest levels, or expected to, going back a year, 680,000 new jobless claims. That's still a lot. We're still talking about initial jobless claims that exceed prior records. I mean, this is incredible how slow the recovery has been. Show me the money, show me the data. John, that is very much what people are going to be looking for going forward, as you were saying. 10 a.m., we're going to be getting the ISM manufacturing data out of the United States following some other ISM or some other manufacturing data at 9:45. Interesting to see how much the supply chain disruptions are feeding into a slowdown in manufacturing and an increase in input costs. How much will we actually see that come through in the survey? And then at 1:15 p.m., President Biden holding his first cabinet meeting. Again, the timing not coincidental, given the fact that he's trying to push forward this infrastructure plan. We call it an infrastructure plan as shorthand for this $2.25 trillion wide-ranging plan that will probably be broken up into many pieces. It is an agenda, John, and the question now is how it will get done and whether it will get done and with whose support.
Let's talk about our spending plan right now. Something that jumped off the page for a lot of us in the White House statement just yesterday. The greatest challenges of our lifetime. You'd expect them to say climate change. The second piece, Tom, the ambitions of an autocratic China. And this president has talked repeatedly about China potentially eating our lunch. The former president would talk about the fact that they already have done and whether we can change the course.
Well, the portion of 2.25 trillion that folds into, you know, to use a general phrase, cyber and all that, but it's really about information technology, John, not only domestically, but also to get an edge on them competitively worldwide. What I see is huge agreement on bridges, tolls, on internet structure across the nation, and then that's where we engage. And part of that engagement of debate is about China.
Let's bring in Jared Woodard now, Bank of America Securities head of the Research Investment Committee. Jared, your line, not mine. We update our view on the US-China shift from trade war to capital war. What does that mean, Jared?
Well, hey, John, it means that this goes from a very narrow, fight around soybeans and then maybe semiconductors under the last administration to, in the future, much more open-ended, all hands on deck, complete total mobilization. Well, that's the theory anyway. When we looked at this bill, one of the things we saw is that although, of course, you guys are right, there's this bipartisan, rhetoric. There's some unanimity politically in Congress. I mean, Congress voted unanimously, I believe, to delist Chinese ADRs from U.S. exchanges last year. But when we look at this bill, we find something a little bit different. The numbers don't seem to quite match up. I mean, if you think about research and development, which is undoubtedly, the front lines of the future of new technology and who's going to win the future, I think the Chinese National Party of Congress just approved something like $500 billion for R&D. They've been beating the U.S. on this measure for a while and really ramping up. The bill that the Biden administration just produced, well, it's not $500 billion. I think it's about $180 billion for research and development investment. And that doesn't sound like catching up to me.
Dr. Woodard, Tom King, good morning to you, and I really want to congratulate you folks. It is rare that someone at any bank puts out a research report where the world stops. I think John and I and Lisa can agree that when Woodard publishes, really the whole global Wall Street world stops to read what he's talking about. Jared, what do you and Bank of America say about what institutions are going to do with their cash? Not what the public's going to do, but what is global Wall Street going to do with their cash in a boom economy?
Well, Tom, there is some reason for optimism because our view of Bank of America is that we're on the cusp of one of the biggest capex booms in modern history. I mean, I think you'll have to go back to Ronald Reagan to see a period over the next 5 years that will look, quite like this one. So we do expect that industrials, technology, other firms are going to be expanding capacity rapidly. Part of that's just an organic rebound coming out of the recession, but part of it is going to be finding unmet demand that they'll want to build into for the first time in a very long time. And so we do expect that there's going to be new building in property, plants, and equipment. I mean, real fixed assets, physical investments, not just intellectual property, not just ways to squeeze, more efficiency out of workers, which has been the trend for quite a long time. So if we have 2% capex growth, as our trend for a while, our economists expect, our analysts expect a wide-ranging surge, and I think that's going to be a real positive for U.S. GDP.
Jared, how do you factor in potentially higher taxes on corporations with this expectation for a capex boom?
It's a tricky moment. Obviously, a lot of corporate leaders are going to push back about this, and I think it's important to keep in mind from the Biden administration side of things that this is undoubtedly an opening bid. You have to play bad cop before you can play good cop. You have to show to progressives that you tried to hike taxes on the rich and hike taxes on corporations, et cetera, so that when moderates come in and then push back, you can sort of make some compromises. So I don't think anyone expects that the final bill, whatever does get passed, will necessarily look like this. But that being said, I think everyone agrees, including corporate leaders, that if you grow the pie enough, paying a slightly higher share of taxes is a trade well worth making.
Jared, this is the analysis. What's the market call?
The market call is that reopening's priced in. I mean, the summer spending, the wet, hot American summer that we're about to get, where everyone, goes a little bit nuts for a little while, is going to feel great for the real economy. It's already priced into Wall Street, and it may not feel great to Wall Street. Remember April of 2020, you had the real economy in tatters and stocks, ripping higher. I think we're about to see something more like the reverse, in which the real economy reopens. It's a great time for people who need to find jobs, and markets don't really have that much actually to go on. So it could be a little bit of a digestion moment. I think what matters more is what happens when you do see infrastructure pass. Now, we're going to be talking about this for a while. There's going to be a lot of political back and forth, this summer around these bills. I think it's one of these unusual moments where you actually want to, sell the rumor and buy the news. Like buy once you actually know what's in the bill and what can get passed and what will get done. And on that front, I think, investors have not at all, priced anything in, are not ready and not positioned for what's going to come. It's just going to require a lot more analysis until we get there.
Jared, I want to finish on this idea of how individuals are going to spend cash, not just corporations. And you had in your phenomenal note the idea that 69% of the excess savings, the excess cash savings in the United States, about more than $1.5 trillion, has gone to the top 20% of income earners. The idea here that they are less likely to spend, perhaps not as inflationary as people had expected. Can you please elaborate on that?
Absolutely. Lisa, we know from history that folks who already have quite a lot of money don't tend to spend it in an aggressive way if they get a little bit more. That's not true for middle and lower income households who are sort of, hand to mouth. Every paycheck matters. So historically, when you give some extra income to the bottom brackets, they will spend it more, and that's been the kind of hopes I think in the Biden administration, even the Trump administration last year, in terms of getting aid out to people. What we found in this survey is that some of the respondents are telling us that with these $1,400 stimulus checks, they're actually going to save most of it, or majority said that they're going to save, either keep it in cash, pay off debts, maybe save it in some financial assets, put it into the market. But they're not going to be spending it in the real economy by the same degree that history would suggest. And that's why our economists expect, yes, a surge in inflation this summer, a bit of a wild moment, but that by next December, we're back below 2% inflation.
Jared, before you run, let's talk about something else your economists suggest. The team, Michelle Meyer leading them, 1 million tomorrow, 1 million payrolls growth. What's behind it, Jared?
I think you're seeing, in some parts of the country where folks are keeping it tight, where things haven't changed very much from 6 or 9 months ago. But other parts of the country, they reopened already, and I think that's going to feed through to the job numbers because people, want to get back to normal. Employers want to get back to normal, and they're not waiting for the CDC to tell them that they can.
Very true, Jared. We've said that repeatedly on this show, that's for sure. Jared Woodard, Jared, good to see you. Joining us from Bank of America. Let's take a look at the price action. As Jared tells you, the reopening is priced in. It's the NASDAQ ripping right now, Tom. Up 0.9% on the NASDAQ 100. The S&P up just a third of 1%.
Right up near 1% as well. Equities all green on the screen. And some correlation, not as tight as the last couple of days. Guess what? Everybody focused on 8:30, John.
Yep. Initial jobless claims just around the corner. Before we get there, here's been a guiding light through the reopening and this equity market rip off the March-April lows of last year. It's Mike Wilson of Morgan Stanley, and he joins us at 8 a.m. Eastern Time in about 50 minutes' time. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Pfizer's coronavirus vaccine remained highly effective after 6 months. That's according to new long-term results. Follow-up data from a final stage trial showed the vaccine was 91% effective in preventing symptomatic cases. The time period went from 1 week after the second dose to 6 months after. Republicans in Congress are opposed to the way President Biden wants to pay for his $2.2 trillion infrastructure plan. The president wants to raise the corporate tax rate and set a 21% minimum tax on global corporate earnings. Senate Republican leader Mitch McConnell calls the president's plan a Trojan horse that brings with it more borrowed money and massive tax hikes. An OPEC's official is warning that oil demand remains fragile. Secretary General Mohammed Barkindo told energy ministers, quote, "We should not be out smelling the flowers just yet." OPEC and its allies meet today for talks on whether to prolong their vast production cutbacks. And another blow to Hong Kong's beleaguered opposition. The city's so-called father of democracy, Martin Lee, and media mogul Jimmy Lai were convicted of attending an unauthorized protest back in 2019. 5 others also were convicted. They'll be sentenced next month. The verdict came shortly after China approved a plan that effectively ends open elections in Hong Kong. Verizon has won its first industrial 5G deal in Europe. The American carrier beat out local telecom companies to build and run a private network for Associated British Ports Holdings in Southampton. Terms of the deal weren't disclosed. Verizon opened up a showroom in London last year and talked about its hopes to win 5G enterprise deals. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
We're going to raise the corporate tax. It was 35%, which is too high. We all agreed 5 years ago it should go down to 28%. But they reduced it to 21%. We're going to raise it back to up to 28%. No one should be able to complain about that.
You'll find someone to complain about that, I'm sure about that. That's the President of the United States on a higher corporate tax rate. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Live on TV and radio, here's the price action. In about 1 hour and 12 minutes' time, we have jobless claims in America, and those jobless claims are still too high. In a bond market, yields are lower by a couple of basis points to 172 as we kick off Q2. In your equity market, had a little look at 4K yesterday on the S&P 500, Tom. 39.78 right now, up 1/3 of 1%. And NASDAQ 100 futures kicking things off for the second quarter of 2021, higher by almost 1 percentage point.
I'm glad you mentioned that, John. Folks, we've got a level up here, 331 over to 41, Q1 into Q2. And, John, I would just note the VIX, where are we? Well, we've come in from 23 to 18.55. Let us remember, just before this horrific pandemic, the VIX at a nirvanic 13.68.
Expectations of a better year, Tom, just soothing this market in many ways. Now it's about the data, and that starts tomorrow.
It's the data on the labor economy, and then we march right on, and I'm with Gina Martin-Adams. Earnings season has never been more mysterious and important, is what we see. Right now, Kevin Cirilli with us. We brief off of President Biden and this historic moment for the nation yesterday. Kevin, I want to go to the process that you live and breathe in the marble halls of Congress. How do you define the process forward and the specificity of this bill? Is it an amorphous blob to the assembled legislators, or will they actually know what's in the zillion pages of this bill?
They're going to go through committees. 3 points. First and foremost, yesterday was an opening bid. Come June, July, secondly, come June, July, Speaker Pelosi will move infrastructure ahead of the August recess, most likely. That's her working timetable. And then thirdly, after the August recess in the Senate is when Minority Leader Mitch McConnell and Majority Leader Chuck Schumer will have their stab at this. But this is yesterday was an opening bid, and this is now at least a 9-month process to see the piecemeal approach of what gets done.
Brilliantly explained, but are they in the weeds as we go through that 9-month process, or are they only arguing about 2,250 billion here or 630 billion there? Do they actually know what's in the bill?
There are aspects of the proposal yesterday that have wide bipartisan support. I'm thinking of the $40 and $50 billion for various supply chain diversification and bolstering security amongst research and development at agencies and universities. And beyond that, though, to your point, There's another nuance here, which is that come the fall, they have to pass some type of funding bill in order to keep the government open. So the fall hijinks that we've become accustomed to in Washington, D.C. are going to continue.
Can you talk a little, Kevin, about the urgency of this timeline, the idea that the midterm elections are a line in the sand for Democrats right now?
Well, also for Republicans. I mean, typically any time you get into the first quarter of a calendar year, or really anytime you near the holiday recess of the year before a midterm election, typically any type of mammoth-sized controversial legislation, the chances and windows of opportunity rapidly closes. So the fall is really candidly when there could be an actual opportunity for legislation to be passed. So I think if you're looking at the elements of this bill, and this is very important to do to try to forecast out, the elements of this bill that are not poison pills, like raising the corporate tax rate, like taxing offshore profits from the current level of 13% to 21%. It's the national security, it's the 5G, it's the digital infrastructure, aid for research and development. That is a nonpartisan issue that would be able to garner widespread support.
It seems like that would be the case, and yet there was a story on the Bloomberg today about how Chuck Schumer is trying to go it alone with his $100 billion plan for semiconductors because Republicans don't like how much he plans to spend. I mean, how realistic is it that there is any bipartisan support for any provisions here, given how bifurcated Washington has gotten today?
You know, I hear you. I think with respect to leadership on both sides of the aisle in the Senate, I think today's the morning after. I think, you know, March and September is an eternity away. But I do think I thought it was interesting yesterday when the president corrected himself, in which he called Senator Mitch McConnell the majority leader, and then corrected himself and then said the minority leader. But I think I think it speaks to the notion that he did speak with Leader McConnell earlier this week before heading to Pittsburgh. They've got a long relationship.
Hey, Kevin, do the politicians care about the analysis, including Jason Furman, that you take $2.25 trillion to divide it by 15 years, you come out with $150 billion per year, and as a percent of GDP, it's a rounding error.
You know, you're losing me with the math, but so no, the answer is no. Here in Washington,
See that, Lisa, how he does that?
You'll get a slide ruler in the mail, Kevin.
He's so Washington.
I know. Where's my TI-83 Plus, Tom? Look, no.
Well, that's the problem. You should be using an HP 12C, but we won't go there.
Go on, Kevin, please.
Look, I think you hit it on the head yesterday, Tom, that Washington is in an era of spending, and deficits and whatnot are not being considered. Potentially, they might be in a debate, a robust debate for conservatives ahead of 2022, but Washington's got the checkbook out, and they're willing to write a lot of checks.
Hey, Kev, good to see you. Run. Kevin Cirilli, Chief Washington Correspondent, host of Sound On, Bloomberg Radio, weekdays, 5 p.m. Eastern Time. This conversation for me started with Michael McKee. This is not the $900 billion bill that got passed at the end of last year. It is not the $1.9 trillion bill that got passed in the last month. This is a $2.25 trillion spending plan over 8 years. And Tom, when you think about it that way, that's why we've got a group of guests, very sensible, quite constructive, neither progressive or aggressively Republican either, who come on this program and say, 2.25 trillion sounds like a lot, but over 8 years, given what we need to do in this country, probably not enough.
I'd take it out to 15 years, which is, you know, a lot of the discussion of the taxes that are going to pay for this. I mean, you can argue 8 or 15, but look, we're a $21,000 billion nominal economy. McKee will tell you we're an 18,000 billion real GDP economy, chain weighted. John, it's a rounding error per year.
Yeah. Let's go through the numbers. $580 billion of that $2.25 trillion is for what they call strengthening American manufacturing. Within that, $180 billion goes to what's billed as the biggest non-defense research and development program on record. Now, if you want to take on China, and this was Jared Woodard's point about 10 minutes ago, if you want to take on China, does $180 billion support R&D over 8 years, Tom? Get it done.
Okay, you know, I think there's all these things, but, you know, I'm going to go where I was talking with Kevin, which is I don't think the politicians care one whit about the minutia and details on this, John. I think they're looking at the big numbers and, excuse me, they're looking at November 2022.
The midterms.
Just around the corner. That's all they're looking at.
I'm with you. Coming up, we'll talk to the White House. Jared Bernstein, White House Council
How much do the
of
Red
Economic
Sox get?
Advisors member. Equity futures
Fenway Park
up
needs,
a third of 1%.
Just keep
Can
going,
see where
John.
your attention is this morning. Yields are down 2 basis points. I've got 2 hours and 30 minutes left.
I'm just going to keep going. Yeah.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action, here's the theme of the morning. It's about buying the rumour and maybe even selling the news. The rumour, we reopen. The news, that could come tomorrow morning. In the equity market, in anticipation of all of this, equity futures up about 1/3 on the S&P. On a NASDAQ, we rip up 0.9%, underperforming in the previous quarter, outperforming on the session this morning. Have a little look on where we are year to date. Let's have a little look at a sector versus the bond market. Switch up the board and finish on this. Treasuries versus banks. Theme clear. Up 80 basis points year to date so far on US 10s. The banks absolutely ripping, up more than 22% in anticipation of a better year ahead. Finish on this. Switch up the board. Get to crude. WTI year to date. We are up on crude by almost 23 percentage points. The energy index up by 29%, again, in anticipation of better demand, a better outlook. But Thomas, Jared Wood has said a little bit earlier this morning, is this reopening already priced? And is this a buy the rumor, sell the news event? And I can tell you, Q2 is all about the news. It is all about the data. It's no longer about anticipation. It is about the data and the reopening and the stellar data points we're about to see in this country.
Yeah, I'll go with that, John. And the data here to me, folks, is the foreign exchange market, where renminbi today is really out to new weakness. We're really buttressed up against a breakout to new yuan weakness. We see a yen. Who would have thought a yen 110.76, a print of 111 on USD JPY would really be something, John. So I'm watching FX again as a global litmus paper.
Dollar strength, the surprise of Q1. We'll take a little look at that with TD Securities and Mark McCormick in just a moment. Let's get you to move and say hello to Romain Bostic. Hey, Romain.
Hey, good morning, John. Well, let's talk about buying the rumor and, well, buying the news, because that's what we're seeing in the EV space here. We talk about Biden's plan and sort of what might see the light of day once it gets through the political sausage grinder. There does seem to be consensus out there that the proposals on the EV stuff, that actually is going to make it through. It's not only the $174 billion in direct government spending that he's proposing, but it's what that direct government spending could mean for private spending, whether that could be a catalyst for additional private spending. You're seeing that not only reflected in the big names like the Teslas and the GMs of the world, but keep an eye on the charging stations. ChargePoint has already been out front on this, talking about how this is actually going to spur additional spending by the private companies. Blink, Ideanomics, a couple of other charging companies to also keep an eye on that space as well. QuantumScape, of course, which already has a deal with Volkswagen, actually met one of the key milestones in its development of batteries there. Those are a lot of the names that investors are now starting to really sort of kick the tires on. Remember, we saw a rally in these names up until the announcement yesterday, but that rallying continue here in the pre-market. Flip up the board, because another big development here is going on in the chip space. We had some interesting comments here. First, Micron came out with earnings, much better than expected, showing continued strength with regards to computers as well as smartphones. But more importantly, they said a lot of that demand and some of the supply issues that have actually worked in its favor, that's going to continue into 2022, according to its forecast. That's given a bid to Micron, WDC, and a lot of those names. Then you had Taiwan Semi come out. Remember, Taiwan Semi a few months ago said it was going to do about $28 billion in capital spending this year. It's now saying that it's going to triple that over the next 3 years. So basically doing about 30 billion per year for the next 3 years, saying conditions have actually changed in its favor just in the past few weeks since it made that announcement.
Romain, you follow this better than me, and I'm really, really glad you mentioned Micron MU and what they've done. I believe there's a tech correction going on. I'm looking at Micron's chart, and that's a horrific correction.
Yeah, I mean, there's a bit of a correction going on, but keep in mind, a lot of the correction that we saw in the tech space, that has actually been, there's sort of been a less of a correction than what we've seen with regards to the Philadelphia Semiconductor Index. You're talking about an index that basically closed about 2 points below its all-time high yesterday. And keep in mind, you're getting, look, Tom, that's basically your third best performer on a sector basis year to date, and you go back to the March lows we had from last year, the only thing outperforming it is energy. You throw in for year-to-date basis, it's financials. So look, if you're looking to invest on a sector-by-sector basis, right now it's basically chips, financials, and to a smaller extent, energy.
Very good. Romain Bostic, thank you so much. Let us move on right now to someone with, as we end Q1, a magnificent call with Toronto Dominion Bank as our global head of FX strategy. Mark McCormick, and among others, has absolutely nailed the resilient or even stronger dollar call, really out of consensus in November, December of last year. Mr. McCormick visits us to take a victory lap. Mark, I'm not going to mince words. It's a great call, and you mentioned a simple framework.
Okay, traders, it's time to place new trade for British pound. Okay, I'm looking to sell short British pound. The price I'm looking to sell 137.775. Okay, this is where I'm going to place a order to sell short. So if you're looking to sell short British pound, it's time to place an order and follow this trade, and I'll let you know when we're going to place stop on profit and how. I don't really know how long it will take. It might take a couple of minutes, it might take several hours, but we always end up with profit. If you want to get the strategy, you can find from our website, and you will find out how we find this exact price, why exactly I placed order to to sell short this pair at this moment. If you still skeptical, still want to find out if it's for you or not, just follow our trade. It's free. You don't have to pay anything at all, and you will find out for yourself if you like it or not. Okay, look like it's still we still hold position on order. Couple of few orders was before our order, so it didn't get filled. If you got filled, well done, but for us, not yet. I'll speak to you later when we'll get filled. Stay safe.
Very hard to predict the vaccine rollouts. So there's an element here where there's a lot of great news priced into the U.S. The consensus has moved probably bullish U.S. dollar. And I think we're actually in the period right now where the global economy is starting to accelerate and growth numbers are positive, where the dollar rally pauses a bit. And especially what we see in April is strong seasonals where the dollar weakens.
Mark, put simply, where do you think the sources of upside surprises come from? What I hear you saying is elsewhere.
Yeah, I think you have to kind of take around the world. Like the euro is really, again, not an anchor for the global pickup around the world. I think what you want to think about is currencies that have good value, that would benefit from the terms of trade that's moving the right direction in some relative shifts in growth. There's some interesting stories in Latin America. Again, our EM team likes a relative value trade of buying Mexico versus Chile. In the G10, New Zealand dollar looks really cheap on a short run basis. You can see a nice move there. And I think as we kind of step back, it's really, if we look across Europe, Euro and Swiss are going to be underperformers to sterling in Norway. And I think Norway is still kind of your key currency you want to focus on in the euro because it has all of those factors. Carry, the central bank's moving. It's got growth. It's the strongest performer in growth and on mobility and, the COVID story in Europe. And also on the last side of it, it's linked to the global reflation and commodity cycle.
Mark, I'm struck by this idea that central bank policy is sort of a lesser influence here, if any at all. And I'm wondering how that factors in going forward at a time when the Fed will probably be moving. Certainly.
Okay, great. Position open on British pound. Short position at 137.775. Well done. Let's follow this trade and stay with me. I'll let you know what's going to happen next. Okay?
The bank side is we're seeing central banks being less dovish. Basically,
probably won't take long, but we will see.
Central banks lowering rates on a global scale. So what's interesting is if you line those up to the dollar, prior to 2017, the dollar correlated quite well with the central bank, a global central bank diffusion index. So the more central banks were cutting, the stronger the dollar got. That correlation is zero since 2017. I think a lot of it has to do with the way that central banks have changed their policy stance, but also the macroeconomic implications of the Trump policies, kind of change how people navigate around central banks. I think on the growth side, what's happened is it's been very consistent that people have always thought about relative growth fundamentals for currencies as a driver. So you don't want to ignore the central banks. You want to buy the currencies that have clear growth and clear normalization prospects. And that's, if you look at G10 specifically, year to date, the central bank relative value trade explains about 25%. The relative growth trade explains close to 70. So, CAD's doing well because of the normalization of the Bank of Canada, but there's not too much clarity on the central bank policy. But you don't want to be expecting the dollar to rally when global central banks are becoming a little bit more hawkish.
How do you sort this out with respect to China, the idea that they are trying to get a little bit tighter to rein in some of the leverage at the same time that their growth outlook is perhaps decelerating just a touch?
Yeah, I think what it does is it nudges the dollar remedy range a little bit higher from where we were. It's probably a shift of maybe 2 to 3% from where we were to start the year. Again, what you're seeing in the U.S. is, especially if we talk about the infrastructure package, there's going to be less spillover into the manufacturing sector and probably less capital flows into Asia, which means there's less dollar diversification going through on the reserve cycle. I think the other thing is obviously the magnitude of the shift in U.S. real rates really closed the gap between real rates between the U.S. and China. So that, obviously nudges fair value a little bit higher, but we're still in a world where, the U.S. and China are competing on not equal planes, but they're offsetting and both have good stories.
John, can you imagine Mark McCormick at a bar? He brings the bar like to a complete stop, talking knocky stocky.
What I was thinking was in a bar in London. Whenever I catch up with Mark, it's like being back in London. The Chilean and Mexican peso cross. Mark, can we just touch on it for 20 seconds? I thought Chile had a great rollout. Had a great rollout of the vaccine. Why are you short that versus the Mexican peso?
Well, that's a good question. I think clearly one thing is Banico has gotten a lot more aggressive. A lot of people are
doing this just for you, Sam. Carry on, Mark.
Yeah, a lot of people are expecting a little bit more of a dovish cycle. What we're seeing is they're obviously shifting towards a focus on inflation and inflation expectations. They're a lot more hawkish than people expected at the last meeting. They're probably going to tighten probably at least 75 to 100 basis points over the coming year. And again, if you think about the U.S. infrastructure package that people are talking about, who benefits the most from U.S. growth? Canada and Mexico. So if you're thinking about energy, links to North American growth cycle, Canada, United States, and Mexico are all linked to that relative to, say, Chile, which is a play on base metals and potentially
Thanks,
Asia.
Mark.
Oh, you guys,
John,
you just egg him on.
You hear that
John,
sucking sound?
You're worse than he is.
That's the sound of the audience just...
How about,
TV.
How about that MXN CLP?
Mark McCormick of TD. Thank you, sir. I'm almost there. Almost at that long weekend.
We're going to make it feel long, John.
Are you going to San Diego?
This feels really short. This feels really short. Little known fact, Lisa at the Chicago school lived in Chile.
It's true.
For a year.
Yeah.
There you go. Wanted to see the real life action of, what was it, conservative economics.
Yeah.
Is that what piqued your interest?
That, and I really like avocados.
Oh, do you? Okay. From New York City, futures up 39.81 on the S&P. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden says he's open to good faith negotiations with lawmakers on his $2.2 trillion infrastructure plan. Republicans already are making it clear they don't like the way the president wants to pay for the spending. He's proposed raising the corporate tax rate to 28% plus a 21% minimum tax on global corporate earnings. There are racial disparities in vaccination rates across the U.S. According to data by Bloomberg, states and cities have inoculated almost twice as big a share of their white populations as they have of their black populations. In 7 states, including Arizona and Florida, that gap is more than twice as big. Some healthcare providers say it's taking longer to build up trust amongst communities of color. Bloomberg's learned that a manufacturing error affected 15 million doses worth of an ingredient for Johnson & Johnson's vaccine. J&J is downplaying the situation. The company says it's met its most recent coronavirus vaccine delivery target, and it says none of the doses made in the U.S. so far have come from the plant where the error happened. After dismissing digital currencies for years, some Wall Street giants are warming to the idea. Goldman Sachs is now close to offering investment vehicles for Bitcoin and other digital assets. Morgan Stanley plans to give rich clients access to 3 funds that will enable ownership of crypto. Still, none of the biggest U.S. banks provide direct access to Bitcoin and other digital currencies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishika Gupta. This is Bloomberg.
The nice thing and the desirable thing for me about infrastructure spending, it's a long-term investment. It should help in future create higher potential GDP growth, higher sustainable growth, better productivity. So I would really differentiate infrastructure spending from other fiscal spending.
That was Robert Kaplan, the Federal Reserve Bank of Dallas president. On this particular bill, this spending plan, we have a lot of people that agree with it. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Your price action looks like this on the equity market. On the S&P, we advance 1/3 of 1%. On the NASDAQ, up 0.9 of 1%. And Tom, when I say we have a lot of people that agree with it, I'm talking about economic circles. There was huge debate over the $1.9 trillion plan. Larry Summers raised some big questions about it. Let me tell you, speaking to us in the last 24 hours, Summers very much on board, Tom, with what we've seen.
Yeah, he's on board with what we've seen. And of course, this is very different. This is actually money applied, whether you agree or disagree with it. It's not like a check in the mail. This is money applied to different programs, John. So I think a different prism, a different analysis is in order.
So let's talk to the White House right now. I'm pleased to say that back with us is Jared Bernstein, White House Council of Economic Advisors member. Jared, you'd have to forgive me. The last conversation we had was about whether the bill was too much Now we're having a conversation about whether it's too little. 2.25 trillion over 8 years. Why does this get it done?
This is like the Goldilocks story of economic policy, right? It's too hot, it's too cold. The bill is of a magnitude to really dig into the infrastructure deficiencies that have evolved in this country over so many years. And as some people have said, some in praise, some in criticism, we define infrastructure quite broadly here to include not just roads and bridges, which are essential and something the president's long talked about, but also clean energy, housing, the care economy. There are many components to this bill. The fact sheet is 25 pages long. And of course, there are a set of pay-fors that more than pay for the expenditures over 15 years.
I want to pick out one of the numbers, Jared, 180 billion of which goes to what's billed as the biggest non-defense research and development program on record. The president keeps bringing up China. In the White House statement, you talk about the ambitions of an autocratic China, a challenge of our time. And we've seen the Made in China 2025 plan that was released several years ago. Jared, 180 billion, it just feels like a dip in the ocean. We caught up with Bank of America about 40 minutes ago on this very topic, who said exactly that. It's not enough. Why do you think it is?
Because I think you have to just look at a lot of other line items and not just that one. This measure, this American Jobs Plan, is replete with many more tax credits and incentives for R&D and innovation that dig a lot deeper than that. There's the ones in the manufacturing space, but there's a full spate of ones in the clean energy space. When you get to electric vehicles, we do a very deep dive into incentivizing the production of not just electric vehicles, but charging station and batteries here in this country. So this is the largest play I've seen in my economic career to onshore industries, to build up nascent industries, to grab global market share in areas where we could beat our competitors.
Jared Bernstein, I want to go to your claim book, All Together Now. The goal here is all together now, and every report I see is a huge body of America is in support of infrastructure, etc. I want you to speak right now to some fancy Republican sitting fat and happy in a suburb about why they should support this bill, even if their senator doesn't.
Well, if they do feel that way, they're among a significant majority. 80% of Republicans support investment in infrastructure. So this is something that is widely recognized, as your own reporting has showed, as a great need. I think there's been a pretty significant disconnect between Republican opposition to anything that comes from the other side and where constituents and the population is at large. And look, Joe Biden got 81 million votes from all of America to not just fight with folks here, but to make sure that he meets the needs of the country, and that's what he's doing here.
What's the mix that you see, and how do you respond to those on the left?
What's the mix that I see?
The mix within the bill, the social programs versus bridges. You know, Gina Raimondo, the Secretary of Commerce, has to fix a bridge in Rhode Island. Great, we all get that.
Yeah.
But in this program, whatever anybody wants to say, there's a lot of social messaging, social hope, and planning.
Well,
how do you respond to progressives that want more?
Well, I mean, it's funny you should say that. I was just reading an article in the Washington Post where Derek Hamilton, who's I think quite a brilliant and also a renowned progressive, a scholar of racial disparities, was pointing out that our definition of infrastructure here is broad, and it should be. Not only does the bill do the kinds of traditional measures we've talked about, and the clean energy and the innovation and the manufacturing part, but there's also a deep housing policy that goes after exclusionary zoning, which is something you rarely see from the federal government, with a really interesting competitive program. And this is an area where systemic racism is embedded. If you look at how we stand up the care economy, this is something progressives care a lot about. So I think if people start looking at what's in here, they're going to recognize that it's plenty progressive, and especially when you get to the highly progressive tax pay-fors.
And I'll just point out that Gina Raimondo is going to be on Bloomberg Television today at 12:30 p.m. to weigh in more. You know, Jared, I think there is a lot of agreement on the end goals of this $2.25 trillion plan. How we get there, though, is a point of contention, and there is this reputation of government-funded operations being incredibly inefficient. People point to the DMV, waiting in line and waiting on it for hours to just speak to someone for a basic procedure. What are you telling people to ensure them that we're not going to end up with 40,000 DMVs that are inefficient and not using money well?
Yeah, that's a great question. I have a two-word answer for you, President Biden, okay? I worked for Vice President Biden at the time during the implementation of the Recovery Act, and he recognizes, really more than any politician I've ever worked for, that simply signing legislation and moving on to the next thing, you know, going to land the next airplane, is not the way to go. We have to, this is a passion of his, we have to show the American people who are footing the bill for this that we are not just signing documents here, that we're paying full attention to implementation. Yeah. And if you look at the distribution and production of the vaccine, I think you see good governance is back in town and at work, and you're going to see that in this plan as well.
I am shocked, Jared, that you think the current president is part of the solution. Let me get to the next question. Looking forward, where's the rest of it? Where are the tax hikes elsewhere? What can we expect, Jared, and when?
I think the president said something to the tune of mid-April in terms of the next part of this called the Families Plan, and I'm not going to get ahead of him on the announcements in there, but
don't expect you to. Just in the time we have, Jared, if you could just characterize the effort just a little bit more clearly for us. Is this a bigger redistribution effort, a bigger wealth redistribution effort that's still to come in a couple of weeks?
Much more in the sense of building back better. That is, this is an effort to dive more deeply into the parts of that you see that you don't see that much in this plan. We do have some care economy in here, but there's more to do there. There's education, and then there's tax issues on the personal side of the code. So there's more to get back to, and we will in a matter of weeks, not months.
Jared, people view this plan as being a starting point to negotiations. Picking up on the tax point, are the higher taxes on corporations and individuals making more than $400,000 non-negotiable going forward?
Well, the president has put that 400,000 line in the sand, and that's something he has continually elevated. And I don't want to say anything's non-negotiable because the president has consistently shown that he's willing to reach across the aisle and try to get input from the other side. But that's been a very solid commitment of his. I think that the idea that we're going to just keep doing things and never paying for them, if you want to come forward with different ideas of how to pay for things, as long as you recognize that 400K boundary, you know, we're willing to listen.
Right. Dr. Bernstein, will the Congressional Budget Office score or analyze this bill, and what will be their timeline? 8 years, 15 years, or 30 years?
Typically, the Congressional Budget Office uses a 10-year budget window, so that would be their timeline. Now, this is about an 8-year spending plan, but the tax increases just continue on forever. So by year 15, the revenue raisers pay for the plan, but the CBO tends to use a 10-year window.
Jared, it's always good to catch up, and we appreciate the ongoing contribution to this program, sir. Thank you for the transparency. Jared Bernstein there, White House Counsel of Economic Advisors. As Tom, we look ahead to mid-April. Next stop now, mid-April. Where are the rest of the tax hikes? The proposal, no doubt, will come in a couple of weeks.
Tax hikes in America is a good way to get unelected or to become unemployed as a politician. So that part of it will be interesting. Certainly, John, right now there's been a change, a partition between the corporate analysis and the individual analysis.
400K, that's the red line, Tom. Get a real sense of that, don't you? 400K. Anyone
I don't
earning
know
under
if that's 400K? A line in the sand. I wonder
Heard it from him right there.
How that migrates.
Lisa?
That's what he was saying. He was saying that basically he's willing to listen if anyone comes with a proposal for how to pay for this. They can't just keep proposing things without paying for it, as long as they recognize that $400,000 line. There is a question still remaining, though, John, and I don't know that we've heard it really, the idea of whether that's a household income or individual income. It seems like the language has moved more toward individual income. Right. But still, how much will it go up? What are the details? Will it be for the entire income or just the increments above 400,000? All these details still to be worked out.
John, I would suggest that Europe does this better than America. They put a longer timeline on these projects. We are unable to get out past 2 election cycles maybe, and where you get to 10 years, 15 years. What do you pay for a bridge in Montana? Is it 20 or 30 years out? I don't know.
Some places in Europe, I caveat that, Tom, some places in Europe, because Germany has got a huge problem to do exactly that. And I do wonder how we'll look back on this period, this era of low interest rates, and how we'll judge these economies by this period of low interest rates. And away from America just for a moment, let's talk about Germany, Tom. Record low interest rates for about a decade. Do you think this government has made the most use of that opportunity to reinvest into the economy?
No, they're battling. And again, this is culture overlaid across all this political and economic analysis.
From New York City, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro with 2 hours to go. Coming up, Mike Wilson, Morgan Stanley Chief US Equity Strategist. This is my personal count. This is my personal. I'll get to tweet weekend in about 2 hours' time. Ahead of Mike Wilson, futures up 15 points.
The city's cold and empty.
Of 1%.
No one's around to judge me.
It's a good song, isn't it?
I can't see clearly, John,
it's
when
beautiful.
you're gone.
That's what I wake up for, Tom. You singing. Equities up on a NASDAQ by 1%.
Baby.
This is Bloomberg.
Dr. Phil.
That Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
Friday is Jobs Day on Bloomberg Television and Radio. A special 4-hour holiday edition of Bloomberg Surveillance will bring you the March job numbers live. Coverage begins at 6 a.m. Wall Street time on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
at the doorstep of finally getting a better look of what this recovery looks like.
It's very mechanically driven, completely unnatural as far as recessions go. So now the recovery is somewhat unnatural as well.
All those who were saying that we were going to get inflation like you've never seen so far have been proven wrong.
There's certainly capacity to be surprised to the upside.
I think we're going to see the strongest economic growth in 50 years during 2021 and 2022 combined.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Beginning of the second quarter. No April Fools. Green on the screen. Markets up big. And John, the market votes off what President Biden said. The NASDAQ up over 1%.
The NASDAQ climbing this morning. NASDAQ 100 futures. The story of the session, not the story of the quarter. Q1. Just massive outperformance on small caps, Tom. Massive outperformance on the banks, on energy too. Have we seen enough of this reopening trade before we actually see the data in Q2?
We're going to recalibrate on that. Michael Wilson will join us from Morgan Stanley here in a moment. John, your observation on the global response. Tom Orlick at Global Economics for Bloomberg's got a boom global economy off of a boom American economy.
I'll let the market talk for me. The dollar index last month, best month since November 2016. Why?
I nailed
because
that call.
Growth in America is looking so much better compared to what we see out of, say, Europe, Tom. That's been the story in Q1. How that changed in Q2, Q3, that's the big unknown for me. Relative to expectations, the bar for America going into Q2, Q3, it's pretty high.
And Lisa Abramowitz, you've had the courage to get out before the immediate here to Q3, Q4, dare I say even into 2022, into this Q2. It's a mystery, isn't it?
The idea here that we're going to have a hot economy, that we're going to see growth rates that we have not seen in the United States since the 1970s. But what does that mean for the longer term? And I think that there is a growing feeling that that means burning hotter in the short term and a shorter cycle, which raises a lot of questions about how much conviction you can have with some of these bullish trades.
Someone sounds like Morgan Stanley.
Well,
Honestly,
I'm trying to
lead
it in. Yeah.
Just trying to tee this up.
I think it's working.
She's working well. Let's do one more thought here before we get to Mr. Wilson of Morgan Stanley.
Thanks,
we'll
Tom.
look at the data as well. John, you mentioned earlier this good news, this continued good news from Pfizer, the efficacy of what their research shows out 6 months, out a year. The pandemic good news, the fact is it continues.
Remains effective 6 months out, Tom. That's the latest headline from a Pfizer study. And also, it looks like you can get that efficacy still with the South African variant too. The numbers are just fantastic. 2.83 million doses per day on a vaccine front. That's your average daily rate over the last 7 days in America.
We thank all of you for listening and watching. Yesterday, traffic off the road nationwide. Derek Jeter commenting on Red Sox pitching. We thank you all for your comments there later as we talk to the gentleman running the Miami Marlins as well. John, save me with a data check here. Futures up 16. John, the VIX 18.44.
Yeah, I'm going to try. I feel kind. I'm not going to be here for the next couple of days.
Oh, you're not. You're going away. The weekend starts today.
Starts in a couple of hours, Tom.
Who knew?
In the bond market, yields come in 3 basis points, 170.54, supporting that move in the NASDAQ. NASDAQ 100 futures up by 1.1%. And in FX, the surprise that caught a lot of people offside in Q1, big dollar short position coming into 2021. A lot of that's been unwound. Euro dollar 117.43. Tom, up about 0.1%.
And very importantly, folks, seriously, we want to make note here within the schedule of this holiday week for all of you. We will be here tomorrow for the jobs report. We'll go beneath the headline date at 8:30. I believe scheduled with me, Lisa Abramowitz, scheduled to appear. Is that true, Lisa?
Yeah, I can confirm that my weekend does not start today, even though John will keep rubbing it in that he will be off tomorrow.
Pulling the
I'll be here with you.
Mine bleeds into next week too for a couple of days as well.
That's very good.
It's very European. It's what we
get the
do around the
Friday
Easter holiday, Tom.
You take time off.
Take a couple of days either side.
How British. Yeah, well, we'll be here Monday as well. Romaine Bostic helping out tomorrow as well. It'll be interesting to see. Right now, Michael Wilson joins us. Mike Wilson, he has been dead on with Morgan Stanley on small cap. Mike, let me just cut to the chase. How do you adapt and adjust to Q2?
Yeah, well, thanks, Tom. I think the Q2 is going to be the actual reopening, right? So the dream of reopening, the dream of restarting the economy is always, bullish. And it's there's no prove it moment. Now, as we actually reopen the economy, we're going to have to do it. And execution risk goes up. So that's not the end of the bull market. It's not a disaster. But at the stock level, we're expecting disappointment. I mean, we think it's going to be difficult for a lot of companies to manage this. And oh, by the way, some companies are going to take advantage of it take share and will operate quite well. So one of our recent calls is, we did downgrade small caps. It's had a heck of a run, and it's kind of a lower quality area. And we're basically recommending that people do upgrade the portfolio a bit on the quality side as we go through this reopening period in Q2 and Q3.
Is it fair to say you think this is a sell the news event, Mike?
Well, I don't think it's a sell the news in terms of, equities over bonds in that regard. I think it's more of a, let's just get, the low quality part of the trade has really worked. As you know, John, we've been bullish from the lows on the idea that's what always happens, and low quality does really well coming off a recession. We looked at that data recently, and the relative outperformance of low quality over higher quality and some other things we can talk about has been extraordinary. Small caps over large, for example. And we just want to capture that because this is the time of the recovery in any cycle where you revert back, you have a little consolidation, and quality actually becomes more in favor again, at least temporarily.
A foundation for your call, Mike, along with the rest of the team, has just been where we are in the cycle, the old playbook, the reopening, the recession playbook, the early stage part of the cycle. We've moved on from that. In your words, you and I have caught up several times on this in the last month. Now you're thinking about the duration of the cycle, the intensity of the cycle as well. Can you add in those dynamics and why that shapes your thoughts right now, Mike?
Yeah, we've been waiting to write this note for a couple of years, to be honest, because we always felt that, as we went into this recession, we didn't predict a pandemic, but we felt like this next recession was going to challenge policymakers because we were still very close to the zero bound. And this transition to fiscal policy has only been accentuated by the fact that we're in a pandemic, right? There's no governor on what, politicians can do because it's a health crisis. And that was a perfect foil for this accelerated transition to a new regime. We think it looks very much like the post-World War II period in many ways. We wrote about this. And what that really means, bottom line, is that we're likely to have more of a boom-bust type outcome. In the last 30 years, as rates have been coming down, the Fed has been allowed to be extraordinarily accommodative, and that's why you had these long economic expansions. There was no pressure from monetary policy. But we're always shooting below trend on targets on growth and inflation. We think that's changing now. And what that means is more frequent recessions. That's actually a great investment opportunity if you know what you're doing. That's cycle analysis 101. And that's why we think this note's pretty important for people to read.
So, Mike, how are you preparing for the bust and when could it be?
Oh, look, the next recession is not anytime soon. But look, let's talk about the last couple of expansions, Lisa. It lasted, 8, 9, 10 years. We think it's probably more like 4 to 5 years. So, and so what that means in the very near term is you move out of that early cycle playbook to more of a mid-cycle playbook. And that means, once again, low quality tends to, not perform as well. As an example, small caps tend to not do as well. We just upgraded consumer staples relative to consumer discretionary. Consumer discretionary tends to be the best early cycle performing group. Well, that period's probably coming to an end. So there's a lot of things to think about in your portfolio construction.
How does big tech factor into this, Mike, especially considering how high the run-up was and where valuations are?
Yeah, so tech is, obviously from a cyclical standpoint, tech should be doing quite well because obviously as you come out of a recession, things like semiconductors and some of the more cyclical parts of tech, benefit from that. There's going to be a huge CapEx boom. I think that's something to look forward to. And so like tech hardware, some of the older traditional type tech companies that could benefit from that may do better. For us, it's a neutral for a couple of reasons. Number one, the pandemic was unusual in that we saw a pull forward of demand last year for a lot of technology companies as we digitized the economy and made it easier to work from home. So there's going to be some payback on demand. The short term there, we think that could be a bit of a headwind. But then structurally, longer term, this idea that rates are now bottoming from a long-term perspective and they're going to continue to rise is going to be a headwind on valuation for some of these secular growth companies. So it's much more about picking spots and trying to find things that can buck that trend.
Mike, 10 years back, 15.6 per year. 20 years back, 8.7% per year SPX. 30 years back, 10.3% per year. The great wrong call has been it's an actuarial single-digit equity world. Forward, can you be double-digit?
In the U.S., I don't think so over long periods if you buy into our view that rates are bottoming. The reason those returns have been above trend, Tom, is directly proportional to the fall in long-term interest rates. Stocks are long-duration assets, okay, and they do better when obviously rates are falling. So if you buy into the idea that rates have bottomed for the long cycle, that's a headwind. And that's not, once again, it's not the end of the world, but it's harder. It's running into the wind.
Mike, tremendous. always getting us there to think more. Mike Wilson there, Morgan Stanley, Chief US Equity Strategist on this market as we reopen and the data starts to come through tomorrow. Sometimes you need to pause, reflect, and get some real perspective on some headlines that cross the Bloomberg. This from CVS Health. They're giving vaccines in about 2,000 stores now here in America. But here's the number, Tom. CVS Health surpasses 10 million COVID-19 vaccine doses administered. This is CVS Health in America. Now, here's the perspective. I want you to think about this. 10 million doses administered at CVS Health in America. Do you know where France is at right now? 11 million. Italy, 10 million. Spain, 8 million. Germany, 13 million. They are countries versus a U.S. corporation, Tom, and that U.S. corporation largely because of the effort of the federal government, granted, but it just goes to show you the compare and contrast in America and Europe right now is just staggering.
And what's so important here, John, is, and I witnessed this on my trip out west, John, I was at the Motel 6 and we went over to Venice Beach just to see what the young kids are doing. The young kids are much more comfortable, particularly those uncomfortable about getting vaccinated, about going to a CVS than they are about going to some big intimidating building.
Well, I think that that's true. I think that also it's just access. People want the shot. People want to get out. They want to go do things. And I think, John, back to your point, this question of whether the CDC is going to come out with better guidance. And I say better because I mean more applicable to what people are actually doing. We're going to have people basically creating their own rules.
The reason I bring this up is because at the height of this pandemic, we thought Europe could respond better with socialized healthcare. And what we've seen in America is a mix of both the federal government and the private sector level really coming together in a massive way and delivering big time in a way that Europe, even with a socialized healthcare system, just has not been able to. From New York City, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Futures are positive, up 15 on the S&P. On the NASDAQ, we're up 1%. This is Bloomberg.
With the first word news, I'm Ritika Gupta. Pfizer's coronavirus vaccine remained highly effective after 6 months. That's according to new long-term results. Follow-up data from a final stage trial showed the vaccine was 91% effective in preventing symptomatic cases. The time period went from 1 week after the second dose to 6 months after. Republicans in Congress are opposed to the way President Biden wants to pay for his $2.2 trillion infrastructure plan. The president wants to raise the corporate tax rate and set a 21% minimum tax on global corporate earnings. Senate Republican leader Mitch McConnell calls the president's plan a Trojan horse that brings with it more borrowed money and massive tax hikes. OPEC's official is warning that oil demand remains fragile. Secretary General Mohammed Barkindo told energy ministers, quote, "We should not be out smelling the flowers just yet." OPEC and its allies meet today for talks on whether to prolong their vast production cutbacks. And it's another blow to Hong Kong's beleaguered opposition. The city's so-called father of democracy, Martin Lee, and media mogul Jimmy Lai were convicted of attending an unauthorized protest in 2019. 5 others also were convicted, and they'll be sentenced next month. The verdict came shortly after China approved a plan that effectively ends open elections in Hong Kong. Investors are showing their loyalty towards the famed ARK Investment Management founder Cathie Wood. 2 of Wood's exchange-traded funds added around $1 billion in a single day this week. Her flagship ARK Innovation ETF took in a record $717 million on Tuesday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Ritika Gupta. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This American Jobs Plan is replete with many more tax credits and incentives for R&D and innovation that dig a lot deeper than that. There's the ones in the manufacturing space, but there's a full spate of ones in the clean energy space. When you get to electric vehicles, we do a very deep dive into incentivizing the production of not just electric vehicles, but charging station and batteries here in this country. So this is the largest play I've seen in my economic career to onshore industries, to build up nascent industries, to grab global market share in areas where we could beat our competitors.
Two different administrations, two different presidents, yet you hear the same words. Onshoring. Jared Bernstein there, White House Council of Economic Advisors member from New York City this morning. Good morning. Alongside Tom Keene and Lisa Brambitz, I'm Jonathan Ferro. Let's touch on a price action this Thursday morning as we count you down to initial jobless claims about 12 minutes away. Then payrolls tomorrow morning at 8:30 Eastern Time. Lisa, Tom, will be here. In the bond market, yields come in three-way.
Way to do that.
Even I can't keep a straight face. 170.37 on 10-year yields. We come in 3-4 basis points. In the equity market, 39.82 on the S&P, up 0.4. The Nasdaq doing nicely. Tom Keene, the Nasdaq 100 up by 1.1%.
Very good, John. Right now, we will talk about the airlines, and we often talk about the major airlines, and something different are the many other airlines vital to this nation that connect hubs with their smaller cities. Frontier Airlines has been path-breaking and controversial over a good 20, 30 years out of Denver with the various iterations of bankruptcy of roughly 2008 and their resurgence today with an initial public offering. Barry Biffle joins us, Frontier Airlines President and Chief Executive Officer. Barry, the meat and potatoes of the new Frontier Airlines is, say, Denver to Las Vegas, 2 hours and 5 minutes. You're going to compete with the big boys, and you're going to do it on a regional basis. How do you avoid the failures of Frontier Airlines from the past?
Well, the main way we do it is low cost. In 2019, we were the lowest cost airline in the United States, not just from an ex-fuel perspective, but fuel as well, because we're America's greenest airline. So we're just positioned much better from a financial perspective than we were in the past, and our brand is stronger than it's ever been.
The brand is strong as it's ever been. Do you need the big airlines to survive? Are they your friend or enemy?
they're not, I don't guess we're friends or enemies. Look, they're in a different business. They
Yes.
carry corporate. We focus on the leisure domestic traveler, and we're just in a different business.
What is the strategy forward out of pandemic? Delta yesterday announcing the middle seat and all that. I don't even know if Frontier has a middle seat to Billings, Montana. But what is your pandemic strategy out?
Look, I mean, we have, from the beginning of the pandemic, we put safety first, that of our employees as well as our customers, and we were leaders in the space in terms of, innovating new things like the temperature checks and the health certification and so forth. But now, we're moving beyond that. People are getting vaccinated, and the country's reopening again, so that's what's exciting now.
Barry, why IPO now? Why not back in 2017, 2018 when you initially were thinking about it?
Well, look, IPOs are there's never a perfect time, but I'll tell you today is a great time because it's, we like to joke that we were low cost and low fare and leisure oriented before it was cool. So look, there's never been more excitement about leisure travel, and there's never been a better time for us to be positioned for the next 5 to 10 years.
What are you going to do with the money, Barry? Is it going to be plugging a gap from the months and months of people not traveling, or is it going to be investing in new airplanes and new routes and competing with bigger airlines that are perhaps hit harder by the slower comeback of business travel?
Yeah, look, when you look at us through the pandemic, we took on the equivalent of about $1 per passenger over the next 5 years in debt. But the rest of the industry took on $16 per passenger. Just massive debt load differences of how we managed the pandemic versus how they did. So, yeah, look, on a relative basis, we're in great shape. But I think when you think about the future, we're just better positioned from a cost structure at a time when all this leisure demand is coming in.
Barry, I want to pick up on some words you used. Before it was cool. And I just wonder how much competition you're expecting now from some of the legacy carriers here in the United States, given the fact that it is cool now, given the fact that people are worried that business travel doesn't return quite in the same way. Is this set to get even more competitive, and where does your edge come from?
Well, look, there is so much demand. There's plenty of room for all the capacity that's hitting the market. The question is what are they going to be paying? And so when we look at our cost structure relative to theirs, we can make money on low fares. But if your costs are double ours, it's going to be a hard time making money at the fare levels that we sell at.
Barry, touch on the demand for us right now. Just give us a picture of how things are developing in America, the surge you're already seeing, the bookings over the last week or so.
Well, I can tell you in the last week, being in New York and here at the NASDAQ today, the excitement's huge, right? I mean, the quarantine was just removed for New York State today. And you can just feel it in the energy this morning in the city. But I'll tell you, overall, over the past month, we went cash positive at the beginning of March. And that's just a reflection of the demand that's out there. And, you think about the vaccine, it's just unlocking all this demand. People have got plenty of money. Think about it. In January, there was $3.9 trillion in people's pockets, and that was up 70% year over year, and that's before the $1,400 is coming into people's pockets with the latest stimulus. So you got plenty of money in people's pockets and a huge amount of demand to get out of your house and get going. So I just think it's never been a better time to be in the airline business.
Barry, you're talking about how other airlines have more debt per the dollar of their value than you do. How much do you expect prices to increase of these plane tickets, both among your competitors and then for yourself?
Yeah, look, I can't speak for what they're going to do with their prices, but obviously they've got a lot more pressure if you have higher costs, and you'll want to reflect that in some way to pay that back. But that's why we're so excited about ourselves, given that we took on less than $1 per passenger. So it's not an impairment on us. But look, if they're raising prices, you'll have to ask them.
Barry, before we let you go, vaccine passports. Controversial subject right
question.
now in the industry.
Come on, Barry.
What's your position on it?
Really, Tom?
Yeah. So what's my position? Well, look, I think it would be great if you could implement it. There's just a lot of challenges with it, and I think in the U.S., given the vaccine is really already knocking down the hospitalizations. Yeah. I don't know how necessary it's going to be, but I think when you're traveling, between countries that maybe one or the other has still a lot of infection, I think it makes sense, Barry, especially on international.
I got to go with you, the pride of Gainesville, Texas. I'm going to cut to the chase. Are you happy with the opening up of your Texas? I mean, can you support the governor, or do you need to see a different strategy in your Texas?
Well, if you look at the facts, I know they got rid of the mask mandate, and if you looked last week, their cases hadn't changed materially versus some other states. So there's something else going on. But look, I'm from Texas, and I'll always be proud of being from Texas.
Hey Barry, we don't expect that to change. Good to catch up, sir. Good luck today, Barry Biffle there, Frontier Airlines president and CEO. Do we say Frontier or Frontier?
Frontier.
Frontier.
We say British Airways. Okay, British Airways. Ryan Airways.
And
We
then
don't
they
have trouble with
asked for
it.
me to buy
Frontier.
them soda. So you've got to buy. Seriously?
90 minutes left. Coming up, Neil Dudder, Renaissance Macro Research, head of macroeconomics, ahead of a huge payrolls report. 90 minutes left for me before the long weekend. In your bond market, yields are in 4 basis points on 10s. Frontier. I think Frontier. What's 70-37? We should have asked him. This is Bloomberg.
It's Frontier.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But it's very close to that. This is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. I'm not talking energy only, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to breathe it in. Specifically the startup mode and things happening. Buses all around you here.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required.
From New York City for our audience worldwide, good morning to you all. Alongside Tom Keane, Lisa Bravitz, I'm Jonathan Ferro. Jobless claims data in America coming out imminently in the next couple of seconds. Ahead of that, futures up 0.4% on the S&P, on a NASDAQ up by more than 1 full percentage point. In the bond market, yields come in about 4 basis points to 170.37. Here's the data. Here's Mike.
John, we come unfortunately higher with jobless claims. Last week we broke through the 700,000 barrier. We broke through it the other direction this time. 719,000 jobless claims filed last week, which is going to be a surprise to a lot of people because we thought that the trend was going to be falling with more and more states opening up and the economy seeming to heat up, but that's not the case. That's an increase of 61,000 from the previous week's level. The previous week's level also revised down to 658,000, so it's a bigger jump than even it appeared to be during the month. We look at the number of pandemic claims, the freelancer claims, they're at 237,000. So still a lot of people out there not working and trying to get some sort of assistance from the government. We also had some changes, and I'm not seeing exactly how this is working, but there are going to be, I know you got Neil Dutta coming on. He can spend his day a big drop for last week because remember they had to change the seasonals because the way the economy went into the tank so fast, and so they've changed the seasonals and they've gone back and looked at it and tried to figure out exactly what it means.
Right. Michael McKee, I've got out the HP 12C. While Mike G. Hammered away, I'm looking at the Hewlett-Packard 12C calculator. Looks great on radio. Good morning.
Yeah.
On Bloomberg radio. And Mike, I take the revision and I take where you are now, and it's a meaningless 18,000. You know, a better number and a worse number. Are we splitting hairs before what really matters tomorrow?
Sure. With jobless, well, first of all, jobless claims are people who've lost their jobs, so it doesn't directly translate into jobs, the payroll numbers, which are people who got jobs, but it does give you a sort of a sense of direction, and the problem we have here is that the direction is not good. We thought we would be reversing it. I don't think these numbers are particularly accurate in terms of the total amount, given the double counting fraud, the difficulty in processing jobless claims this high, but it does suggest that the economy maybe is not recovering as quickly as some people had hoped.
And John, the market recovers quickly to a lower yield.
We do see a move here, 169.65. The Treasury market was big coming into this print. Off the back of it, yields a little bit lower. We break below 1.7% after breaking above 1.77% early this week. Off the back of that, Tom, yields in just a little bit. The dollar a little bit weaker. 93 handles still, but down around about 1/10%, negative 0.15%. One thing that does hold, one thing that sticks, the equity market still up 0.4%, Tom, on the S&P 500. The NASDAQ 100 up about 1.1% still. Not big moves. I'm with you. I'm not trying to add some drama here, Tom.
John,
he's doing that for you.
I'm draining
88 minutes.
the drama.
Come on, John, focus.
He's
I'm
draining
draining the drama. I can't wait for tomorrow morning when I'm not here.
All right, Mike, let's drain the drama from these numbers, and let's talk about how elevated they are still at this point in the cycle. We're talking about this booming recovery. We're talking about a V-shaped economic boom, and yet we still have incredibly elevated numbers. Can you give us a sense of what's behind them? I mean, why can we justify 719,000 new jobless filings at a time when we're supposed to see hiring? We're supposed to be seeing springtime in America.
It is hard to reconcile with all of the anecdotal stories we get about how the economy is performing right now, because again, as you say, these are new claims. These are not the continuing, ongoing number of people who haven't gone back into their previous jobs yet. These are new claims, so it's kind of hard to know where all this is coming from. We know there's massive fraud out there. We know that the states have had trouble counting, but we're still at such a level that it's hard to square. We do have coming up tomorrow, the employment report is at 650,000, and I wonder if this is going to weigh on anybody. We got some million.
Mike,
we got some people.
Are you going to be here tomorrow?
I'm going to be here tomorrow.
Good. Well, thank God somebody's going to be here.
Yeah.
Hey, what am I?
Head of our labor economy.
Me and Lisa and Tom and
not John.
And we're going to be talking about John behind his
Do you want
back.
me to do a phoner?
Yeah, please, John.
From the airport.
Do
you want a
phone from Capri.
I can give you a
Here's here
phoner.
tomorrow. Let's get back on track, sir, because
Might
we've got
have
a
a
wonderful
drink in my
guest,
hand at
Tiffany
8:30
Wilding.
Eastern, but you can have a phoner.
Tiffany Wilding morning with us tomorrow. We're waiting for a phoner with her. Jim Glassman with us as well. Ellen Zentner and Jim Glassman, thrilled they're with us. And we are thrilled to bring you Martin Walsh, the former mayor of Boston, the U.S. Labor Secretary. Marty Walsh, one of the really interesting selections by the Biden administration. We've been setting this up today. April Fools, it's a gloom economy, which means you must speak with Neil Dutta. He has been one of the most articulate and persistent optimists, and he gets the victory lap of this Q1 that we have seen. He's with Renaissance Macro Research. Neil, your hallmark is granularity of data. You mentioned the Google Mobility Index. What's the Dutta Mobility Index look like right now?
I mean, it's getting stronger. I mean, my own personal economy, is that what you're talking about? I mean, I'm out and about more.
You're out and about more. I mean, that's the thing. We're all out and about more, right?
Yeah, absolutely. I mean, you know, you talk about jobless claims. I mean, this number is coming after the survey week, so why anyone would actually adjust their expectations about tomorrow's number based on what we saw with claims, which we know is basically a useless series, you know, in terms of economic data analysis at the moment. You know, the presence of sky-high jobless claims obviously hasn't been enough to keep hundreds of thousands of jobs from being created over the last number of months. You know, we've seen some slowing at the turn of the year, but it looks like things are picking back up again.
Well, Neil, honestly, your optimism has been correct, and you've been persistent in this V-shaped recovery, and now other people are getting on the same boat. And yet there is this question, are these numbers simply useless? 719,000 initial jobless recovery claims right now at this point in the cycle, or does it indicate something else going on under the surface that perhaps doesn't question the optimism, but it perhaps questions how quickly we will get to that peak growth that people are expecting?
No, I think the only issue there is that people are just suffering from cognitive dissonance. I mean, look, do you honestly believe that 700,000 people are getting laid off every week with consumer confidence basically at the same level it was in 2017?
So do you say that these numbers are fictitious? I mean, where are they coming from?
They're not fictitious. No, I mean, I'll put you to that. I mean, the news is real. The analysis is fake. I mean, I just think that it's, you know, what's the point of using these numbers?
In what way is the analysis fake, Neil? Just build on that.
I think anyone that's trying to pitch an argument to in our business, basically the sell-side economics research business, that's trying to pitch a call for the economic outlook based on initial jobless claims data. You know, I mean, if you're paying for that, you're wasting your money. Okay, I mean that's what I think.
And Neil, it's a really, really good point. So let's just build on it a little bit more, because this is where you've been strong over the last 12 months. You've disregarded some of the more dramatic numbers and looked to a better economy and a better labour market outlook. It wasn't always this way, though, Neil. It used to be very useful to look to claims. What's the big change, Neil, and will it be helpful in the future?
Well, I mean, I think you can look at a variety of different data points. I mean, you know, as an example, this morning we got the layoff announcement numbers, right? And if you look at the level of layoff announcements, they're actually at a pandemic cycle low. But, you know, we know the census is doing weekly data, the Small Business Pulse survey. That's actually showing small firms hiring more now than they have at any point in the last, you know, since last summer, when we were adding 1 million jobs a month on average over in the third quarter, for example. So, you know, you guys have a consumer. I just think that if consumers are telling you that they're as confident now as they were in 2017, it strains credulity to think that jobless claims are you know, this many people are getting fired each week.
Neil, just as a time, I want to cut to the chase. Ed Hyman was on yesterday, and I think you and Mr. Hyman are on the same page. If that's the case, what data should we pay for? What data matters right now?
His data, Tom. What do you think?
Well, I think we're all looking at, you know, some of the same data points. I mean, what people are looking for is sort of thoughtful analysis around it. But I just think that, you know, you have to sort of to me, I think looking at survey measures of economic activity right now are quite useful because we know that the hard data bounce around. I mean, obviously, February was a very sluggish month for the U.S. economy. I mean, 3/4 of the country was covered in snow. You know, we weren't really fully reopening at that point, so that's gaining more traction now. But you just run down the list, right? I mean, we know that more people are traveling through our airports, right?
Yeah.
We know that more people are heading out to the restaurant. We know, you know, for all this talk about you know, the viruses, the economy, and so on and so forth. Well, vaccinations are picking up. You guys are telling me that 2.5 to 3 million people every day are getting vaccinated. That's going to mean that people are going to loosen their own personal restrictions, and then the economy will be off to the races. So I think that the service sector in this economy is gearing up for a significant boom over the second and third quarter of this year on a scale we probably haven't seen in growth rate terms.
Right. Neil Dutta, thank you so much. Important comments there. John, I cannot emphasize enough, this is the heart and soul of the market economics debate. This goes back to Alan Greenspan and Ed Hyman and Neil Dutta. They say, look at the granular data. Jim Glassman with us tomorrow is in the same camp.
I'm hoping Neil's still with us. Is Neil still there? I've got another question for Neil. Neil, good. Thank you. Tom, don't be so hasty. Neil, just a final question. I think a lot of people are still processing.
I thought, John, you were gone on your weekend already.
I've just got one more for Neil. All right, just one more. Neil, we're still processing the huge effort down in DC here. And you've been optimistic and you've been right. And what I hear from you is that you still think people underestimate this recovery. So if it's 1 million this month, maybe next month, what do you think they underestimate still? And can you put some numbers on it, Neil?
Well, I think what's important in terms of the labor market, what's important to realize is that the distribution of job loss, you know, during the pandemic has been highly unusual. I mean, it doesn't cast the same wide net that, you know, the financial crisis did. We're talking about, you know, largely leisure and hospitality jobs. Those jobs tend to skew lower productivity, right? Lower wage, right? And so what that implies is that you don't need as much GDP growth to get you the same kind of jobs growth, right? So the labor market shortfall was disproportionate relative to the GDP shortfall. By the same token, on the upside, you don't need as much GDP to get that many more jobs. So, you know, it just tells you that we can have a much stronger labor market recovery than not going
Really
forward.
smart, really smart. Neil, thank you, sir. Neil Dutta, Renaissance Macro Research Head of Economics. I just wanted a little bit more time with the three of you before I go. Coming up, JP Morgan Chase Bank Head of Cross-Asset Thematic Strategy, Anastasia Amoroso, and then Matt Hornback, Head of Global Macro Strategy. Tune in for the guys tomorrow morning, 8:30 Eastern Time. They'll be here. I won't. This is Bloomberg.
So much love.
With the First Web News, I'm Rishika Gupta. Republicans don't like the way President Biden wants to pay for his $2.2 trillion infrastructure plan. He's proposed raising the corporate tax rate to 28% plus a 21% minimum tax on global corporate earnings. One White House advisor is skeptical of what the Republicans are saying.
80% of Republicans support investment in infrastructure. So this is something that is widely recognized, as your own reporting has showed, as a great need. I think there's been a pretty significant disconnect between Republican opposition.
Meanwhile, some progressive Democrats say the plan doesn't spend enough. There are racial disparities in vaccination rates across the U.S. According to data compiled by Bloomberg, states and cities have inoculated almost twice as big a share of their white populations as they have of their black populations. In 7 states, including Arizona and Florida, that gap is more than twice as big. Some healthcare providers say it's taking longer to build up trust amongst communities of color. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Chang explores how a chip shortage snarled everything from phones to cars on a Bloomberg television special, Chip Crunch, Wednesday on Bloomberg Technology.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Concerned by corporate tax increases of this magnitude. I think they'll make us more fair, and that's before you even get to the substantial benefits that are going to come from repairing an infrastructure that in many ways is a national embarrassment.
The former Secretary of Treasury, Lawrence Summers, look for him with Romaine Bostick. Wall Street Week, you'll look for it this Friday and into the weekend as well. Wall Street Week, an important effort there by Secretary Summers. We thank him for his effort. Maybe that's the big picture. Maybe Larry Summers is up at 60,000 feet. John Rico is not. He is at Penn Wharton. He's a budget analyst, and this is really important, folks. This is the geek nerd world of Stata and Python and actually looking at the numbers. John Rico, do you have a clue what is in this infrastructure budget, this bill?
Yeah, so with a caveat that, it came out yesterday and my team's pouring through it right now and we're doing our analysis of this specific plan, it does look very similar to a lot of what the president proposed on the campaign trail. Mm-hmm. So obviously lots of green energy and then paid for this round of his quote-unquote infrastructure plan. We're talking about corporate taxes and in particular a reformation of the international treatment of corporations.
Right. So if you model this forward, John, you have to model out 8 years or a CBO 10 years, and some people even going out 15 years. How do nerds like you do that? How do you actually guesstimate out that far into the unknown?
Sure. So, it starts with getting the latest data and seeing what's coming in. And that's a particular challenge right now. It was much easier to model, for example, the 2017 tax law because we were at a much more normal state of the economy. And so we had a pretty good idea of where corporate profits were going. Right now, that's very difficult and it adds uncertainty to the mix. But, we're looking at different trends in the headline macro numbers over the next few years. And then longer term, we rely on more nitty-gritty sort of micro simulation that looks at the long-term productive capacity of the economy based on demographics, productivity, that sort of thing.
So, John, just to be clear, Tom says nerds like you with love because we all consider ourselves somewhat in that category, just to make that absolutely clear. But, to this point about extrapolating out into the future, there's a question of whether this plan will actually juice growth in a material way over the foreseeable future. Will it actually make productivity increase? Some of these input factors that people say will help the plan pay for itself. How do you model out the trend line in growth spurred by this plan?
Sure. So, again, when we scored very similar proposals on the campaign trail, we relied on basically a project-by-project analysis for the different types of specific spending he was proposing for infrastructure at the time. And there's associated research there where you look at multiplier effects and productivity effects of different types of public capital. And we project those out. And basically our finding was that in the sort of medium to long run, there would be a modest increase in growth. These are things that very clearly add to the public capital stock. And then on the pay for side, we do expect a somewhat negative long-term growth from these additional taxes, in particular, some of the business taxes that he's been proposing. So it's basically a wash. What I will say is that in the near term, next couple of years, this does represent an additional upward, pressure on growth, given just the enormity of the dollar amount involved on top of, the last stimulus bill as well.
Wait, John, this is a really important point, and I want to underscore this. You're saying that over a longer term, perhaps 5 to 10 years, the growth input from this plan would be washed out by the increase in taxes. Is that really what you're saying, that basically the bleed-through effect will only be there for another couple of years?
Well, it depends on the financing mechanism, and, as the president's, own staffers in the White House have said, this isn't really a final bill that they're offering right now. But, relying entirely on business taxes to fund something like this, we do think relative to other types of financing mechanisms, for example, user fees in the form of perhaps gas taxes or, a carbon tax, something to that extent, that is going to, if not entirely, but somewhat limit the growth potential of these more productive investments.
John Rico, thank you so much. Too short a visit. We'll do it again as the numbers firm up with the Penn Wharton budget model. Lisa, really, really interesting. I thought claims today, 18,000 delta over 2 weeks. I don't know what to do with it. The market certainly moved on at lower yields.
Yeah, and Neil Dutta basically saying that any analysis from this number can't be taken too seriously given how quickly it's been moving and some of the fraud charges and the question of how different states are tabulating. Nonetheless, your point, well taken, Tom. Yields are going down. They're going lower, and now we're sub 1.7%, 1.69%. People taking a look at this and saying, well, maybe it's not as quick growth. Maybe the V-shaped recovery isn't as robust as people had expected.
And what's important here is this word resilience. The dollar has been resilient, as we talked to Mark McCormick. Yields have been resilient. I know we've had a huge Q1 move, but we haven't moved up to the gloom levels that so many understood. And to go to the real yield, Lisa, I mean, again, it really hasn't moved in the last 10 days.
And there's a question about the longer term effects, and I'm glad that we were having that conversation. The unknowns here, dramatic, not only what's in the plan, but how long the lag time will be in terms of how that pushes through. I mean, the idea here that if you get something material that actually changes people's existence, could you get more productivity? Could you get more jobs? And right now, the analysis isn't confirming that, but the uncertainty here is really great.
And at Penn Wharton, I mean, with their heritage of looking out at the long term. I mean, we make jokes about it, folks, in the Nerd Alert and all that, but this is backbreaking mental work about guesstimating where this nation is heading, really starting foundationally in 1947. And, Lisa, I look at the ultimate guesstimate here. To me, it's going to be Congressional Budget Office advising Congress of what to do over Kevin Cirilli's 9 months.
This is going to be a tremendous couple of years, I will say. I'm also curious, how much are they going to try to push this through and was one lump package with a number of different provisions, and how much are they going to piece off parts that can get some sort of bipartisan support? I mean, this idea of what Chuck Schumer's doing on the semiconductor front could be significant, at least to that industry, and could potentially garner garner some bipartisan support.
We'll see. But again, the real interesting thing here, folks, is the change politics of the nation, something that we'll look forward to moving on. Speaking of the politics, Gina Raimondo of Rhode Island, now the Secretary of Commerce with balance of power today. That'll be an exceptionally important conversation. And then tomorrow, we move on to our jobs report coverage. Yes,
we'll be here
Friday. We've got a full team here worldwide, frankly. Tomorrow, Romaine Bostic joining me and Lisa Abramowitz for an eventful jobs day. Leading our coverage, the Secretary of Labor, Martin Walsh. You know him in Boston. He will join us. Ellen Zettner of Morgan Stanley. Jim Glassman, as always, and for years with us from J.P. Morgan Chase and Commercial Banking, and Tiffany Wilding of PIMCO. Stay with us through the morning on radio, on television.
Friday, a Bloomberg Television exclusive, a conversation with Baidu co-founder and CEO Robin Li.
We're far from done. We will continue to invest for the next 10, 20 years.
Watch the full interview only on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Goodbye Q1 from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. 30 minutes away from the opening bell with equity futures right now up 0.5%. Let's get straight to it. We begin with the big issue. A warm welcome to Q2.
clearly get acceleration of growth.
Another boom in the economic data.
It's really the U.S. we're talking about.
The growth numbers,
the data for the second quarter is supposed to be outrageously good.
What we got is a really powerful recovery. Joe Biden's spending everything he can.
It's a regime change.
That's really where Congress plays an important role.
We'll be looking at a different tax structure.
Our expectation is that it ends up as a singular legislative.
I don't think they're getting to bipartisan support for tax hikes.
Don't see an avenue for Republicans to sign on to any of the proposed tax increases.
I really don't.
For more, let's bring in the Bloomberg team, Kevin Cirilli and Katie Lyons. Morning, Kev.
Good morning. Let's go through the timetable here because yesterday was just an opening bid. Come the summer is when Speaker of the House Nancy Pelosi is going to move the progressive infrastructure package through the House of Representatives, Democratic controlled, of course, ahead of the August recess. Then you've got a month-long recess, and then in the fall is when, based upon my reporting, I expect for a lot of these conversations in the upper chamber and the negotiations to begin in earnest. There are components of this legislation that do have bipartisan appeal, particularly pertaining to 5G technology, protecting digital infrastructure, as well as enhancing research and development, both in the military but also in the private sector to diversify supply chains. I say all of that because it's going to be a drowning out of noise in terms of the partisan bickering, but it's important to look below that in order to find out what actually likely is going to get accomplished.
Kev, this is going to take a while. This is going to take a while. By the end of the year, we're talking weeks, maybe even months. And what I gauged from the White House this morning is that we haven't had all of it just yet. There's some tax hikes and other proposals still to come in a couple of weeks.
Yes, and so this is, again, an opening bid of sorts. I think you're completely correct to note that. Let's all catch our breath because between now and the end of the year is when the wheeling and dealing gets done. But again, this is a marathon, not a sprint.
Kevin Cirilli on the latest and the opposition on either side of the debate from Congresswoman Ocasio-Cortez. And, of course, on the other side of the extreme there, Senator McConnell saying no thank you. In the markets, it's been about two things. One, expectations through Q1, and then through Q2, it is about the news, the data. In anticipation of that data is Katie Lyons.
Well, John, it's a little bit of buy the news today, at least when it comes to the Treasury market. Treasury is getting a bid, the 10-year yield down about 4 basis points, but we're still hovering around 1.7%, which just underscores how far we have run in, as you say, anticipation of this spending and the growth and inflation that could come with it. The 10-year yield climbed 83 basis points in the first 3 months of the year, the worst quarter for Treasuries since all the way back in 1980. So bonds, a big laggard in the first quarter. Emerging market currencies were as well, and that has a lot to do with the strength we saw in the dollar. The dollar actually having its best quarter in a year, and that has everything to do with that higher yield story. The other big winner in the first quarter was the commodity complex, showing up as both an inflation hedge and as bets for some of the industrial metals that they will benefit from this infrastructure spending. You had stocks up in the first quarter as well, John, but obviously there was a big divergence in the performance of equities. Of course, what did well, cyclically value-oriented sectors that could benefit from stronger growth. Think energy and financials. What didn't do well, growth and big tech. Those valuations called into question by higher borrowing costs. And that's why the NYSE FANG Plus Index and the NASDAQ are off about 8% and 6% from their all-time highs, respectively, as of yesterday's close. The Russell 2000 less than 2% from its high, and Dow Transports within 0.6% in contrast. And then, of course, this morning, John, the S&P 500 could very well open at a fresh record.
Kelly, thank you. And Treasury's saying hello to Q2 with a decent bid. Yields in 4 or 5 basis points on 10s. A break at 170 at 169 right now after a move of 83 basis points, almost 83 basis points through Q1. JP Morgan's Anastasia Amoroso weighing in on the second quarter, running the following. It's worth adding to inflation hedges for the next couple of quarters, with markets focusing squarely on the potential 2 to 3 trillion infrastructure package. Anastasia joins us now for more. Anastasia, you make a really good point, and I want to sit on this point just for a moment. This money is going to be hitting the economy through the next 12 months and maybe beyond, as unemployment has a 4 handle. Do you think we've quite got our heads around that?
You know, I think that's exactly what the market is grappling with right now. And to be clear, we're not saying this is going to result in massive inflationary pressure for years to come. That is not saying. I am saying that this is a transitory pressure on inflation, which is already going to pick up in Q2 and Q3. But I think the markets are going to start to fear, what if there is an inflation overshoot? And what if the Fed is not hiking rates and it lets this inflation rip higher and higher? So I think this is going to be a market sentiment issue that we're going to see in terms of pricing more so than anything. But I think one potential upside as we head into the payrolls day tomorrow, the unemployment rate is already expected to come down to 6%. And if you do have some of this money start to hit later this year from infrastructure and in the next couple of years, then the hiring may potentially accelerate faster than expected. So all of these is what's going to be playing out in the market dynamic and market sentiment. And that's why we think it is a good time to be adding to some of those inflation hedges for Q2 and Q3.
We've been having several debates on this program. We often use the same terms, though, Anastasia. We'll talk about reopening trades, reflation trades. Is there a difference, and why is that difference important?
I would differentiate absolutely between the reopening and the reflation trade. And if you think about it, Q1 was the reopening trade. And the reopening trade is very tied to vaccines and vaccines expectations. If you think about where we started the quarter on vaccinations and where we ended the quarter, we've made massive progress. And the biggest headline over the last couple of days is that 90% of Americans will be eligible to be vaccinated by the middle of April. So this is massive progress. And because of that, we've already seen measures of mobility pick up. And what's really interesting, we've seen forward-looking measures of people booking travel pick up as well. So if you're leisure, hospitality, lodging, airlines, you've likely seen an uptick in activity already, perhaps planning for that summer travel. So to me, Q1 was the reopening trade. Q2 is the continuation of that, but it changed into a reflation trade where we are heading into a very strong growth for the U.S. and probably globally. And so things that should work are not so much the cruise lines and airlines because they have worked already, but I would say the continuation of that is in financials and energy.
Pile on top the $2.25 trillion spending plan, which we are far from an agreement on at the moment, Anastasia. Let's get to your business, the day-to-day business, the themes that you like right now, connected to that infrastructure push in this country.
Yeah, so there's a lot to like from the investment perspective in this potential infrastructure bill to the extent that it does get passed. The thing that I have to call out first is the clean energy provisions. I think this was perhaps kind of the biggest surprise of the bill, really, is that there's probably more than $400 billion tied to some sort of clean energy spending in electric vehicles. So if you look at the clean energy shares, they're down 20%, 30% in some cases. And we have expected a Q1 pullback, just how much they've rallied. But now you have a sector that is set up so constructively as it is. We expect clean energy earnings to grow 48% this year. And then on top of this, you get this positive momentum of the news flow of clean energy. So there's a lot to like there. There's the extension of solar credits, for example. The big one for me is also the expansion of the tax incentives and credits towards the batteries. If you think about the enabling technologies for both EVs and clean energy is all about the battery technology. And so extending that credit is really quite important. So I think investors will be looking for companies that are in the battery supply chain as one of the key beneficiaries there. And of course, that extends to the EV supply chain as well, and extending some of the credits there as well.
Anastasia, that's what I wanted you to build on. This is a massive space, and sometimes people just come on the show, talk about the space, and we move on, and people are left with the thought, okay, I must buy Tesla. Within that space, you mentioned the batteries there, the components, the materials that go into battery making, the infrastructure, the electric vehicles themselves, the producers of those vehicles. Why specifically do you want to position exactly where you said so, as opposed to other things?
Yeah, if you think about the battery is the enabling technology for whether it's a car, whether it's a building that's going to be electrified, whether it's a hybrid electric aircraft, all of this is contingent on lithium-ion battery technology. And if you look at the market forecast, we're already expecting the total addressable market for batteries, global batteries, to double over the next 5 years. And this was before any sort of incentives from the Biden administration. So I think there's a degree of unpriced upside due to what the Biden administration may do, and that is trading right now now as a free optionality. Now, clearly batteries are an important component of the electric vehicles, but they're also really important to stabilizing the clean energy grid, which is electricity that's otherwise not dispatchable. But if you can make storage cheap enough, and by the way, that's one of the objectives of the Biden administration, to cut that cost to 1/10 of what it is today, hence the expansion of the credits to some of the battery technology. If you can make solar so that when it's coupled with storage, it is as cheap as some of the conventional electricity generation methods, that's how you really accelerate the clean energy transition. So this is why I say it's all about batteries, and it's one of the key investment areas. But there's other parts to like in clean energy supply chain in electric vehicles. And for example, some of the inverter companies and the residential installers, this is also quite constructive for building out the distributed residential solar in addition to some of the utility scale that's been done to date.
Anastasia, stick with us. Much more still to cover. Anastasia Amoroso there of JP Morgan Private Bank. Need to sit on one headline that came out about an hour ago, and I think it is so important. It came from CVS Health. Listen to this number. CVS Health surpassed 10 million COVID-19 vaccine doses. 10 million from CVS Health. Now, compare and contrast, and we did this earlier on Bloomberg TV and radio, so forgive me if you've seen this already, but compare and contrast the 10 million we've had from CVS to what France, Italy, Spain are doing in total right now. 11 million doses given in France. Over in Spain right now, 8 million. Over in Italy, 10. Over in Germany, 13. The public-private effort in America has been absolutely stellar. And the procurement in vaccines in Europe hasn't been good enough, and the rollout hasn't been good enough either. And just that headline from CVS, I think, captured the whole story this morning. Much more on that effort still to come. Let's get you some movers. Here's Abby.
John, well, we have big outperformance for the tech-heavy NASDAQ for a second day in a row. Right now, the future is up about 1.2% after gaining by 1.6% yesterday. Let's dig into it. First up, Micron. This company put up a very strong quarter. They beat estimates. Their outlook, both on the top and bottom line, is very strong. They are saying that prices of DRAM are going higher amid the chip shortage, so investors clearly rewarding that stock. But it also extends to Apple and Microsoft. Apple gaining for another day. Microsoft, of course, awarded that $22 billion Army contract. And you and Anastasia just talking about the green energy, the electric vehicle part of Joe Biden's plan. Take a look there at Tesla and fuel cell energy, both popping, really helping the NASDAQ. As for the banks, though, we always check in on the banks. Yields down just a little bit, and we do see that is pressuring the financials, John.
With a bit into treasuries. Abby, thank you. Coming up, we're breaking down the latest jobless claims data ahead of tomorrow's monster payrolls report. That conversation up next with JP Morgan's Anastasia Amoroso and Morgan Stanley's Matt Hornback. From New York City this morning, good morning. 17 minutes away from the opening bell. Equity futures doing okay on the S&P 500, doing better than okay on the NASDAQ to kick off Q2. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We've had a lot of fiscal spending, which has been necessary to emerge from the pandemic, but a lot of that spending will fund current consumption. And so the impact that has is creates a bump in GDP, but over time that bump wears off. The nice thing and the desirable thing for me about infrastructure spending, it's a long-term investment.
It's a long-term investment. The Federal Reserve's Robert Kaplan speaking exclusively with Bloomberg, expecting the U.S. economy to benefit from the surge in fiscal spending. This coming ahead of tomorrow's much-anticipated payrolls report, with estimates ranging from anywhere as low as 232,000 all the way up to 1 million jobs added. 7 firms looking for a number of 900,000 or more. For more on this, Bloomberg's Mike McKee. Morning, Mike.
Good morning, John. We're watching payrolls, of course, because the Fed is watching payrolls. They're not going to move interest rates until we have gotten the unemployment rate down to somewhere close to where it was before the pandemic started, which was 3.5%. The problem we're having right now is data, and do the data really reflect what's going on? Look at this. Initial jobless claims go back up to 719,000 from a revised 658,000. They revised last week lower, and this week we go way back above 700,000. Shout out to Steve Stanley of Amherst Pierpont. He's been saying the jobless claims numbers are useless for months now, and I think I'm about ready to believe him. Do you know, John, that we lost 22 million jobs at the height of the pandemic, but 78 million people have filed initial jobless claims, at least if you total up the numbers. There's something not working here. So we'll look beyond that, and we'll go to the payrolls numbers. And the payroll numbers, you can see there, 650,000, that's not the highest because we did have that immediate snapback in May of last year, April and May of last year, but it is much higher than the trend we had 250,000 or so a month before the pandemic. We're looking for unemployment to fall to 6%, and that participation rate, that's going to be the one that the Fed is really looking at. How many people coming back into the labor force? John, you mentioned the number of people who, the dispersion of the estimates from 1 million at the top to 232,000 at the bottom, and there are just, as you can see there, nobody really has any idea of what this is going to do.
Mike, that's been true for much of the last 12 months.
We haven't had a situation like this since record keeping began, where you basically shut the economy down. I had one economist say, this is not a rebound, this is a restart. And so how that plays out is going to be very interesting to watch.
We're going to see some big numbers. Michael McKee will run you through those numbers tomorrow morning. Let's bring in Morgan Stanley's Matt Hornback, JP Morgan's Anastasia Amoroso. Matt, these numbers are going to be huge, and you're making a big call over at Morgan Stanley. It's going to run hot, but this cycle is going to be shorter. Why, Matt?
John, thanks for having me on. Well, look, I mean, we've got an unprecedented amount of fiscal stimulus in the system. We've got an unprecedented amount of monetary accommodation in the system. It would only make perfect sense to see a cycle run hotter. Now, whether it runs shorter, I think, is going to be importantly dependent on how central banks end up reacting to this better run of economic data that we're expecting. If they continue to stay the course with their monetary policy strategies, it's not clear just how short the cycle will be. Recall, John, it's not going to be difficult for this cycle to be shorter than the last cycle, which of course was the longest on record.
So Matt, you're basically saying this is a call you're making, but it's not as big a call as maybe I think it is, because ultimately any kind of cycle is going to be shorter than what we had before. So Matt, what is unique about this call?
Well, look, I mean, I think the unique part is where we have inflation running in the next year or so. I mean, we have core PCE inflation getting up to 2.3% on a Q4 basis this year and next year, John. I mean, that is going to be unique. We don't see too many cycles in the U.S. produce that type of inflation for that length of time. Now, whether it lasts beyond that, I think is entirely going to depend on the Fed and the fiscal policy response.
Anastasia, I've had a ton of questions in the last couple of weeks on the US dollar off the back of exactly what Matt Hornback is talking about. What's the base case on the dollar index now for you, Anastasia?
Yeah, I think the period of dollar weakness is certainly behind us, the bulk of it anyway. I think we're in a period of stabilization to maybe some modest upside to the US dollar. I mean, I do think that despite inflation maybe running a little bit hot in the next few quarters, the Fed is going to continue to stay pat. So for us, the rate hikes are still not a base case until sometime later in 2023. So it's for those reasons that I don't see the dollar spiking considerably from here. But clearly, the bias to rates is now to the upside. Now, so if you think about the 10-year Treasury, we do expect the 10-year to move higher towards year-end, closer to 2%. So again, that supports a little bit of a firmer dollar here. But I think more than anything, I would look to financials as one of the ways to think about hedging these higher rates and higher inflation expectations, because if we are wrong and if the Fed actually hikes rates sooner than expected, and if the markets at least start to price that in, guess what's quite sensitive to the front end of the curve? It's the financials and the ability to capitalize on those higher rates.
And the banks have already done so well through 21 already. Matt, you're making the call, though, that the Madison bond markets that we saw through February ends in April. Why?
Well, John, we think that there are times in markets when psychology can move prices, and then there are times when prices can move psychology. You know, before the sell-off began, John, we were getting a tremendous amount of pushback on our above consensus calls for growth and inflation. Now, no pushback, John. The price action in the marketplace has completely enveloped people's way of thinking, and those aren't exactly healthy dynamics in the bond market. The amount of short duration exposure out there we think is tremendous. We just think it's too much at this point, John. We have the 10-year Treasury yield ending this year at 1.7%. We used to be above consensus. Now we're basically at consensus, and there are people that have leapfrogged us. That just shows you how stretched the psychology of the market has become.
Anastasia, let's finish there. When we reopened last spring going into summer, expectations for that recovery were low, and we delivered huge upside surprises. Can you walk me through the compare and contrast with the position we're in now relative to expectations, and how you think we perform relative to expectations in the months ahead?
Yeah, John, so a starkly different setup versus what we had in Q2 of last year. When you think about the markets, they actually do best when you're coming from extremely low expectations and they're being revised higher. And we certainly have seen that, just judging from the analyst equity earnings revision. So that's what's propelled this really stellar rally in the markets. Today, we're coming into Q2 and Q3 with lofty expectation. Everybody's expecting a sharp pickup in activity. Now, I do think to the extent that we deliver on those expectations, the markets are going to be just fine. But I think one of the risks there is if we continue to surprise on those expectations and the rates continue to move, and maybe the stimulus is not as paid for as we think it is today, then the rates component is going to start to move higher. So I think what's really still a risk in the market is you've had the correction, some of the high-flying tech stocks and the software and the SPACs and some of those. But to the extent that rates move higher on better growth expectations, you could still see pockets of those high valuations continue to reset lower. I wouldn't say that's true for the broad market, but I will say that for some of the smaller cap names that are forecasting 25% or more CAGRs for the next 10 years, you know, that to me is still a question mark. On the flip side, if you look at the tech stocks, the big tech stocks, you've seen the valuations and those actually reset lower. And they're now trading like GARP names, like growth at a reasonable price names. You've got the mega cap techs that's generating 20% plus earnings growth, and it's trading at 17 or 18 times multiple. So bottom line is, I think we need to be wary of just how lofty the expectations have become. But I think there's a lot to do in different pockets of the market.
Anastasia, we've got to leave it there. It's good to see you. Anastasia Amoroso there of JP Morgan Private Bank, Matt Hornback and Morgan Stanley. Your opening bell, 6 minutes away. This is Bloomberg.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Q1 was about expectations. Q2 is going to be about the data. And just look at this data, these numbers from Bank of America. Total card spending, as measured by the data they track, increased 82% over the last year, 20% on a 2-year horizon for the 7 days ending March 27th. Massive. The data comes, it starts tomorrow from New York. This is Bloomberg. The opening bell is next.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Okay, guys, let's put stop on profit for Japanese yen. Okay, I'm going to place stop on profit at 110.705. So if you enter this trade and if you decided to follow my trade and strategy, you need to place stop on profit just right here. Okay, so whatever happened, you will end up in profit. Okay, so stop on profit placed, and that's it. Let's see and wait what's going to happen with these and other pairs. I'll speak to you later, guys.
going into Q2 and the remainder of 2021. Outside of that, crude up by 2.7%. We add about $1 to WTI, $60 and about 80 cents. We'll talk OPEC and commodities a little bit later this morning. For now, let's get to the market desk. That was your cross-asset price action. Here are the stock movers. Here's Abby.
John, we do have lots of stocks on the move, and I want to focus on the NASDAQ, but we have a redhead crossing the Bloomberg. The S&P 500 breaks above the 4,000 milestone as the bull market barrels on. Really pretty incredible. Now, a big piece of this bullishness, this risk on mood today, the NASDAQ stocks. There's one of them, Microsoft, up 1.1%. They, of course, received a $22 billion contract from the Army. But today, that outperformance for the NASDAQ, as you were pointing out, the underperformer in the first quarter, investors seem to be going that way today, plus being helped out by falling yields. Let's turn to some other stocks moving in the NASDAQ. Chip stocks right across the board. Big gains. And, of course, there's $50 billion of President Biden's infrastructure plan allocated to chip manufacturing. And then to round it out, electric vehicles. Lots of bullish action here, too, for Nikola, Nia, Workhorse. Bullish. And again, that S&P 500 above 4,000, John.
4K very briefly. Abby, thank you. About 90 seconds into the session, we break 4K on the S&P 500. Then we dip back just a little bit. Your sector composition, IT top of the pile, up by 1.23%. Bottom of the pile, utilities, consumer staples. Right now on the S&P 500, where are we on the S&P? 39.99 and up by 0.7%. On the NASDAQ, that is where your outperformance is right now at 1.3%. The outperformance through the last quarter, all about the banks, up more than 20% on the S&P 500. Even in Europe, the banks had a stellar performance there too. But there were some problems in Europe over the last week. And guess who it did not involve? Deutsche Bank, dodging a multi-billion-dollar hit in the wake of the Archegos fallout. Credit Suisse, not so fortunate. David Herro of Harris Associates, one of the Swiss bank's biggest shareholders, calling the incident a wake-up call.
Risk controls still are not where they should be. I think this has been clearly demonstrated. The cleanup should be happening faster than it's happening. Hopefully this is a wake-up call to expedite the cultural change that's needed in this company.
It's a long-term investment, and that's a patient man. For more, here's Bloomberg's Kelly Line.
Very patient, John. Yeah, hey, John. So I want to begin with the Deutsche Bank part of this story, managing to come out of this entire episode basically unscathed after the German bank sold off $4 billion in stocks seized from the implosion of Archegos Capital Management. This was in a private sale last Friday, according to people familiar with the matter. One of the buyers was Marshall Wace, which, of course, is one of Europe's largest hedge fund managers. The other buyers, we don't know yet. But with this $4 billion sale from Deutsche, the known value of liquidated investments in the unwinding of Archegos is now close to $30 billion. And the question remains, how did Deutsche and Goldman and Morgan Stanley all manage to de-risk so quickly and evade any real losses from this episode, while Credit Suisse and Nomura could be facing losses in the billions of dollars? Clearly a divergence in risk management here, John, and you're seeing that show up in the way shares have reacted over the last week. Both Credit Suisse and Nomura down the better part of 20%, while Deutsche Bank, on the other hand, down by just about 2.3%, Goldman Sachs by just over 1 percentage point. And of course, there are other stocks tied up in this as well, one of them being Discovery, and this is where it gets even a little weirder. Discovery's Class A shares, more popular, lost 27% last Friday because of those massive block trades, and it was recovered less than 4% over the last 3 days. But the Class B shares have jumped 147% in the same period, surging 82% yesterday alone on volume, 25,000% a spike in volume. It is unclear exactly what caused this, maybe a little bit of an arbitrage squeeze, traders are saying, but this is a story that is remarkable, and it just keeps getting more remarkable as it all evolves. John.
Kelly Lyons, thank you very much. We spent the last couple of weeks, the last few days specifically, talking about the opportunities and maybe the signs of fragility that we're seeing in this market at the moment off the back of the Archegos fallout. Take a listen to what some select investors had to say.
The fund blowing up has all the elements of the old-fashioned excessive risk-taking.
Another derivative impact of the period that we're in right now.
Not surprising given the amount of liquidity.
Wherever you have excess liquidity, the potential, for accidents goes up.
This is the third near accident we've had this year.
When you get some pressures like this,
the system is telling us something.
Fragility.
I don't think we're done in terms of volatility.
I would expect there will be a lot more volatility in markets.
It's worth taking advantage of.
We are going to have buying opportunities.
We're running a higher level of cash that allows us to take advantage of opportunities like this.
Rick Reeder running more cash, expecting more dislocations and looking for more opportunities too. Let's bring in a panel. John Hancock's Emily Rowland and Chris Harvey of Wells Fargo. Emily, just your first take, please, if we can, on the events of the past week and whether any of those sentiments resonate with you.
Yeah, John, risk management is clearly coming into the limelight here. And as many of your speakers mentioned, when you have these periods of excessive liquidity flooding the market, you're going to get these sort of speculative pockets building in the market. And there's so many examples of this over the last several months, everything from the small cap squeeze to, SPACs and IPOs. And I think this really brings attention to the fact that risk management is absolutely paramount in this type of a market. And we're very mindful of that in our views. We want to have exposure to the reflation narrative. We want to have exposure to this sort of cyclical rotation, but we also want to be very thoughtful about that and keep quality in mind in our asset allocation views as well.
Do you think you should run more cash going into the rest of this quarter, Emily?
We do think that you want to hold on to high quality bonds, John. And I think that's going to be very tricky for clients to do when they get their Q1 statements and they see that the returns that they've earned on high quality bonds are actually negative this quarter. What we don't want to do is for investors to go to cash. Cash is not going to cut it in this environment. There's no way it's going to have the ability to beat inflation. Looking for a combination of credit in a portfolio and high quality bonds, we think is the way to go. And look, this doesn't feel good right now for investors who own treasuries and who own the bar cap ag. We've seen a drawdown of close to 4%. That's about as bad as it gets historically, though. So we have to remember here that higher yields are going to start to look like a more attractive entry point.
7 minutes into this session, we advanced 0.7% on the S&P. It's a break of 4,000 on the S&P 500. Chris Harvey, your words, it's time to dial it back. Why do you think it's time to dial it back?
So, John, a year ago, or a little less than a year ago, we got really aggressive on risk. We got really aggressive on deep value. We got really aggressive on cyclicality, and that's worked out very well. But as time moves forward, the market has carved out a lot of these opportunities. And so as we go forward, what we see is a lot more, or I should say, limited opportunities. Now the focus is less on risk and risk-taking and really mispriced assets down the spectrum. And it's more about really good risk rewards, conservative risk rewards, and there's not a ton out there. So what we're doing is we're pushing up capital a little bit, we're pushing up risk a little bit, not a ton, and we're moving from deep value to more of a GARP approach. We just think that this is a better stance as we go forward because of the opportunities that are presented to ourselves at this point in time.
Chris, I'm pleased I've got you this morning because I was going through your recent research note. High rollers, apple pie, and mall rats are the winners. Can you translate for me? High rollers, apple pie, and mall rats?
So that was in reference to our momentum note. So we talked, momentum has been a very big marketplace for some time and continues to be a very big factor in the marketplace. But as time moves forward, what does momentum do? It starts to morph, it starts to change. And now what momentum is doing, it's aligning with growth, it's aligning with cyclicality. And so people think about high momentum stocks as high tech, high growth stocks. What you're beginning to see is momentum is aligning with a value trade, it's aligning with cyclicality. So you see your autos, your casinos, and some of your mall-based retailers show up as your high momentum trades. And for us, that's very important because a lot of the mall players are very price indiscriminate, they're systematic, and they can bring these stocks to another level.
Emily, your thoughts on the momentum trades that Chris just talked about?
Momentum is a factor that we've stayed away from in our views. The valuations and some of those names look really egregious to us. When we think about, though, I think there was an important point made about sort of where we are in the cycle and what that means for positioning. This cycle is aging quickly. By the way, a horrible analogy for a woman in her 40s to be using, but I'm going with it. And we're already at the tail end of the early part of the cycle where small caps have ripped higher. You know, you've seen values start to really do well. We want to be in a position where we're getting ready for this mid part of the cycle where fundamentals start to matter a lot more. 2020 was all about this recovery in the market. 2021 is all about this recovery in the economy, which is going to help drive earnings, but it's also going to create a big difference between the winners and the losers. So we want to own parts of the market that have great balance sheets, good return on equity, good earning stability, just great, well-run businesses. And that brings us to the quality factor, which frankly is dominated by areas in technology and growth. So it's really about this mix of quality and value for this next stage of the cycle.
Emily, I grew up in a all-female household, and I was taught early on that if a woman starts talking about her age, just walk away. So I'm going to do that right now. You're going to stick with us, though. Emily Rowland and Chris Harvey, thank you. Let's get you some movers. Through 4,000 on the S&P 500. Chris Harvey just nodding there. Abigail Doolittle has some movers for us. Hey, Abby.
Hey, John. Well, big risk-on move on the morning. A lot of it coming from that tech-heavy NASDAQ. Starting out with the clean energy space, because, of course, about $400 billion of President Biden's infrastructure plan is dedicated toward clean energy, electric vehicles. And look at these gains for QuantumScape, ChargePoint, Plug Power, Fuel Cell. This is that big momentum trade. It continues to gain momentum. Now, I have heard GARP, or Garth at growth, at a reasonable price twice on this show from the experts joining you. So let's take a look at a couple of those names, because these are the top movers for the S&P 500 today. We are talking about the likes of Apple, Microsoft, Facebook, and Alphabet. You have lots of growth there, but you can make the case that the valuation is not out of control like those clean energy names. This is what is powering the S&P 500 above 4,000 today, John.
Abby, thank you. Coming up, crude markets awaiting an OPEC decision with inflation concerns creeping in. That conversation is up next with John Hancock's Emily Rowland and Chris Harvey of Wells Fargo. We'll touch base with Anne-Marie Hordern over in London as well on the latest commodity push through 2021. From New York City this morning, good morning. All-time highs on the S&P 500, nicely through 4,000 points. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's uncertain environment, charting a rigid path of recovery is uneasy. The reality remains that the global picture is far from even, and the recovery is far from complete.
The recovery is far from complete. The Saudi oil minister there remaining cautious of an incomplete recovery, recommending OPEC maintain its flexible approach. For more, let's head to London and catch up with Bloomberg's Anne-Marie Hordern. Good morning, Anne-Marie.
Hey, John, good morning. Yeah, what you're hearing there from the Saudi energy minister is a tone of cautiousness. Now, he's had this tone. He's quite steadfast about it for over the past 12 months or so. But I would say there was a moment of optimism. He did equate this all to a ship, and he said they were able to steady the ship even though there is still rough waters ahead. Of course, steadying the ship, he's looking at what's going on in the United States, what's going on in the United Kingdom with the positive rollout of vaccines. You see more and more people taking to the roads, more and more people booking flights. But of course, the past 24 hours, sitting here in London, what's going on the other side of the channel is France locking down again. We're also seeing that in Ottawa. So you have this push-pull in the market between the worries about supply and demand. Alexander Novak, though, he said that he sees the market certainly improving and that it's actually short 2 million barrels a day. So this is the tone going into the meeting, Jonathan. But for me, the wild card came overnight, and this was from the U.S. Secretary of Energy, and she had to say that there was a phone call between herself and the Saudi energy minister, and the note that really struck for me was cooperation of affordable and reliable sources of energy. Is there an easiness potentially in D.C. about higher oil prices? Right now in the U.S., the average for gasoline is about $2.80. A year ago, it was under $2. That has to be a little bit worrisome for the Biden administration.
Anne-Marie, just sit on that just for a moment. Is there any difference between how this administration is approaching this debate at OPEC compared to what we saw with President Trump's administration over the last 4 years?
It's a really good question. I think it comes down to the nuance of how they are communicating. As you can see here, this tweet is quite formal in the sense that there are a lot of discussions going on all the time between energy ministers around the world. This obviously is a little bit more skeptical because it's on the eve of an OPEC meeting that this conversation happened. President Donald Trump would normally take to Twitter, and I've been at many OPEC meetings where he would just flat out say prices are too high, OPEC needs to bring it down, the cartel needs to stop. This was maybe a little bit more reasonable, but I would say the message is the same, John.
Anne-Marie, good to see you, as always. Still with us, I'm pleased to say, John Hancock, Emily Rowland and Chris Harvey of Wells Fargo. Emily, we've seen a massive run-up in commodity prices, crude through Q1, copper through Q1, throw in lumber, food prices, take your pick, massive, massive rally. Underpinning some of that coming into the new year, the calls for higher commodity prices were also for a weaker dollar. The dollar call, Emily, has become so much more complex over the last 3 months, and I have noticed that through it all, when you've come on this program, you've been on the right side of the call. What's been directing you?
John, what we've been looking at is a multi-speed economic environment unfolding where the U.S. is growing faster than the rest of the world, and this has certainly been exacerbated. Coming into 2021, we've had incredibly potent fiscal stimulus. We're now looking at a total of $6 trillion over the past year, which is about 28% of U.S. GDP, which is dwarfing what we're seeing around the world. So that's really been critical to our call. You know, unfortunately, the vaccine rollouts haven't gone as well as planned overseas, and that's creating some challenges to the economic growth backdrop, particularly in Europe. This morning, we heard about renewed lockdowns in areas like France. So as the U.S. economy gets turbocharged here by additional fiscal stimulus and other things going right, that creates a bid for U.S. dollars. And of course, we know that that has key multi-asset implications. First and foremost, as you mentioned, putting potential pressure here on the surging commodities complex. I would just add that one other factor to think about as far as commodities go is China. It's hard to have a commodity super cycle without China at the center of it. And what we're seeing is Chinese growth still doing well here, but that fiscal impulse is actually starting to slow in China. And we've seen a little bit of tightening behind the scenes there. And as that fiscal impulse rolls over, that might create challenges as far as that demand picture coming out of China.
Emily, just looking at the market right now, briefly through 4,000, and as you mentioned, the cross-asset implications of this dollar story, factoring in China as well, you do wonder whether the huge run-up we've had in energy stocks this year so far through Q1 can actually continue in any way, shape or form through Q2. Chris Harvey, your view on that. The energy sector performed so nicely through the first quarter of 2021. Are the dynamics, the forces in place for that run to persist?
I think so, John. One of the things you have to think about, one of the things we have to talk about with regard to the commodities, you're into the shoulder months. So you should start to see some volatility, some downside. But ultimately, what we think is the economy is going to run red hot. And what we keep saying to people in a very flip fashion is it's going to feel like spring break for adults, that people are going to want to spend their money. They have money to spend, and they're going to go out and they're going to spend it in mass. And so the demand is going to be there. People will not care if it's $3 gas. I don't think they'll even care if it's $4.
Yep.
They want to be out. They want to be on the road. They want to go. The demand is there. And so ultimately, yes, energy is very volatile. We see good opportunity there. Ultimately, what we think on the value side is banks and financials offer a better risk reward. But energy, you can find some pretty good value, and we do think that the run isn't over just yet.
Chris Harvey calling this spring break for adults, and it's here until September. Reach out to the Wells Fargo team by all means to talk to him more about that. Emily, I want to finish on something that Chris just mentioned. The demand from consumers is going to be there in a big way. The price tolerance is going to be there in a big way. And Emily, what I'm trying to work out beyond the next couple of months, next couple of quarters, whether that tolerance sticks, and this plays into the broader inflation debate as well. If companies are able to pass on those price rises, those price hikes, beyond the next couple of quarters, if that's something that could persist, Emily, do you think it is?
We think it's something that persists over the next couple of quarters for sure. But we do think that some of these factors are transitory. Yes, I'm excited about spring break for adults as well. But after that initial pop in demand, we actually think that economic growth and consumer spending comes back down to more modest levels. So that does mean that we see, this backup that we've seen in treasury yields start to come sort of back down to more modest levels. And it also, again, means that this cyclical trade that's in effect now, and again, we think should persist for a couple of more quarters here, should result in potentially a rotation back into quality and growth. So you've got to be careful here. You don't want to get too cute with being tactical, and you want to maintain that balanced portfolio, which in fact has been a little bit out of balance if you look at the performance between stocks and bonds over the past year.
Spring break for adults. Who came up with that at Wells Fargo, Chris? Was that you?
That might have been me.
You're responsible for that. Chris Harvey, we'll leave that there before either of us get into trouble. Chris Harvey of Wells Fargo, Emily Rowland and John Hancock. Emily, always good to catch up. Thank you. Let's get you some sector price action in this market right now. Your S&P 500 had a brief dance with 4,000 points. Your movers, here's Abby.
Not surprisingly, John, we do have a bullish sector composition for the S&P 500 with that brief flirtation with 4,000. Let's see where the day ends. Most sectors are higher. Interestingly, up top, your mega cap sectors such as technology, discretionary, along with communication services. On bottom, true defense, utilities, healthcare, and staples. So this is bullish. But what makes it so interesting, John, right now going into the second quarter, we have this year's underperformers leading maybe the catch-up trade. If we take a look at what's really working on the year, as you know, it's energy and banks. Energy up about 30%. Banks, I believe, up about 20%, actually 16%. That BKX up is more. But you have technology up just about 4%. So you have to wonder, are investors now, interestingly enough, playing the catch-up trade in technology? We've seen it 2 days in a row, John.
A big move, up 1.62% on the NASDAQ composite. The S&P 500 at about 4,000 points, up 0.7%. Up next, the market-moving events you need to be watching. That'll be next in our trading diary, ahead of a long weekend. For a lot of you out there from New York City, this is Bloomberg.
Has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
25 minutes into the session, all-time highs on the S&P 500. We break 4,000 points to the upside briefly, up 0.7% right now. Let's just call it 4K, shall we? Here's your trading diary. What you need to be watching through the rest of this week. ISM manufacturing numbers coming up at the top of the hour on Friday. US equity markets closing for Good Friday, but we're still getting the US payrolls report. It crosses at 8:30 Eastern. And can we just look at the expectations going into tomorrow? The high estimate, the low, the high in and around 1 million. And we've got name after name in the mix at the top end of the estimates as well. Bank of America, Michelle Maher and the team looking for 1 million, looking for 1 million. Why? Because the expectations are so great at the moment. Retail sales, stimulus checks. And if we don't see 1 million tomorrow, there's just a belief that at some point, this month, next month, we'll start to see those numbers in months to come. The range, 232 all the way up to 1 million. The median, 650,000. From New York City, for our audience worldwide, enjoy the long weekend if you get a long weekend. I'll be back with you in a couple of days' time. This was the countdown to the open at all-time highs. This is Bloomberg.